nothing matters except AI, 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 and a little more AI.
It's a very narrow market. The earnings are being driven very, very small slice.
We're in a high-risk bull market.
It does feel a bit like a meltdown.
Our personal view is to hedge.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, demand meets supply. Alphabet planning a monster $80 billion equity capital raise as Berkshire Hathaway is tapping into a $400 billion cash pile. Anthropic is taking steps towards a blockbuster public offering. Stocks just about holding on to record highs.
Which is the notable aspect of all of this, given how much supply is coming to market. This is coming on the heels of bankers going to all of these tech companies and saying, this is your moment. If you want to tap the public markets, well, welcome to now. And ultimately, you have a race to try to see who can set the tone first. Is it going to be Anthropic? Is it going to be OpenAI? SpaceX clearly has the lead. Everyone loves what they're seeing. Earnings are coming in strong. Are they tapping the market at the very top?
It's funny, we're talking about this race to IPO, Anthropic, OpenAI, SpaceX. Alphabet got there first. That $80 billion equity capital raise is bigger than the SpaceX IPO. They got in early.
Yeah, if you look at the $75 billion raised from SpaceX, or potentially to be raised by that nearly $2 trillion IPO. You look at Apple, and they are re-IPOing for $80 billion, which is the biggest ever offering of its kind, including different tranches, including a $10 billion piece taken down by Berkshire Hathaway. They need creative ways to finance themselves. If they all do it with debt, then they have to worry about concentration risk. They are becoming creative as they are trying to finance multi-trillion-dollar capital spending programs. Alphabet wants to recreate itself as a chip company. It has gained in the TPU space. It is seeing from the market is wide open for them to
Alphabet has their hands in everything. They're a competitor of NVIDIA now in the chip space. They're a competitor, obviously, with Anthropic and OpenAI when it comes to Google Gemini. This company is one of the biggest buyers of stock on Wall Street, which is why I was shocked yesterday when I read this headline that they want to raise money. Mandeep Singh of Bloomberg Intelligence said it's all about compute. Compute equals revenue. Chase compute, you're chasing revenue.
So we've got some of the biggest companies on the planet. Just take a beat. The biggest companies on the planet investing like they're confronting existential risk, right? Now they're starting to tap all different parts of the capital structure. Okay, so they've gone after the debt market in different currencies over at Alphabet. The 4-month binge is $60 billion, by the way, on the debt side. And now they're going after the equity side. The other interesting piece of this story, I think, is the Berkshire Hathaway piece of this. They've been sat on a $400 billion cash pile for a while now, and they're starting to tap into it too. The amount of money sloshing around, the amount of paper that's been moved in just the last 4 months has been absolutely incredible.
What's even more mind-numbing is that you haven't seen valuations go down. They just continue to go up, which really suggests how much cash there is. Is it going to run out at some point? Well, ostensibly, yes, which is the reason why Anthropic wants to get in before OpenAI so that he can set the tone maybe in a more positive way before the gates close. Nonetheless, this is the reason why people are saying this monetary condition, the financial conditions right now are incredibly easy. So for companies that want to raise money, the moment is now.
We hear this question a lot. What innings are we in? How long is the runway? The first place I'd be looking for potential constraints are so-called capital constraints. Look at Alphabet this morning. Alphabet's down about 2 or 3%. That's not a big move. That's not a major sign of capital constraints. That's what I'm laser focused on right now. Didn't see pushback in the debt market. It's hard to make the argument this morning that you're seeing pushback in the equity market.
Over the past 12 months, Alphabet shares are up more than almost 120%. A 2.5% pullback is not really a pullback. To your point, this is a market saying we are wide open and we believe in your objective.
My whole thing, though, is as we see more of these numbers, as we see more of these companies come to market, what is going to happen in Washington, D.C.? We are talking about an insane amount of money. Mandeep Singh said, even though the CFO of Alphabet said in April that the company's capex in 2027 will be, quote, significantly higher than the $190 billion in budgeted for 2026, Bloomberg Intelligence says 2027 capex could reach $300 billion. Actually, next year, 2027 could reach $300 billion. That is an insane amount of money. And at some point, you're going to hear this become a huge issue on the right and the left, because they're going to say everyday people should get a share.
Well, let's talk about the earnings, and we'll get to that point in just a moment. The earnings from HPE, check it out in the pre-market. That stock higher by 26%. We've seen moonshot after moonshot following earnings. This is another one. And if you look at the guidance from that company relative to expectations, they're absolutely crushing estimates.
Well, this is what I was going to say. On one hand, you could say, take a look at this and say, investors are just getting irrational. Investors are looking at this backdrop and they're saying, we're caught up in AI fever. Then you take a look at the expectations. Revenue will increase about 31% in the fiscal year ending October. That was versus expectations for 19%. You don't see raises like this. Then they gave a guide for 2027 just to say, look, we have the idea that this is going to continue up about 10% versus the 5.3% that was expected by the street. The beats are phenomenal, which is the reason why so many people say, when you ask them, are you worried about froth? They turn, they look at you, and they say, earnings, earnings, earnings. And when you ask them again, they say, earnings, earnings, earnings. That's what we hear from everyone.
Earnings driving that move in a pre-market. HPE higher by around 25% this morning. Futures just pulling back from all-time highs, down about 0.1%. Coming up this hour, we'll catch up with Martin Horne of Barings as Alphabet plans to raise $80 billion. Ted Mortonson of Baird as Anthropic passes OpenAI in the race to go public. And Kit Juckes of SocGen on why a rate hike is off the table for now. We begin this hour with Alphabet planning to raise $80 billion in equity to ramp up spending on artificial intelligence. Martin Horne of Barings writing, equity market leadership is narrow with IT stocks driving performance. This is an earnings-led tech rally rather than multiple expansion. Martin, we've heard that a few times. Welcome to the programme, sir. It's good to catch up with you.
Good morning.
Here comes the supply, Martin. Alphabet tapping the equity market. We're going to see major IPOs later this year. How do you think the demand stacks up with the increase in supply we're expecting in the year ahead?
Well, you know well that the financial markets for a while have been dealing on a wall of momentum. We've seen it in other asset classes like gold, like Bitcoin, like meme stocks, like Mag 7, enthusiasm. And right now we're in the middle of the AI growth and the wall of money that's available to fund these huge, huge IPOs, and the debt issuance that's going along with some of the hyperscalers is there. How far it will go, we're all testing the market right now. You wouldn't want to be a small IPO following the big three that are coming in the near term. But at the moment, it pays, I think, not to over-intellectualize what's happening in the market, because we've seen what momentum of money does. You guys summarized it really, really well in your introduction. This is backed by earnings, so it feels a little different from the dot-com bubble vibes that we may have got just a few months ago. And now we see some substance coming through that's just going to bring that enthusiasm to greater levels, I think.
Yeah, sort of the less you know, which is something that we keep hearing from some of our strategists here in New York. A question about something you noted. Smaller companies might not want to IPO right now. Who are these big companies sucking capital away from? Is there a crowding out effect as a lot of people clear the decks to buy into these IPOs?
Listen, we're all in unknown territory on that, because we've never seen three big IPOs, the likes of which we've got lined up right now, on quite the same scale with quite the same enthusiasm surrounding them. There's lots of sort of technical analysis going on that you have to buy these three names, and that certain market participants will be forced into buying these IPOs on the break. So that feels a bit bubble-esque. That feels a bit dislocated from where true valuations lie. But as you guys have noted on over many, many months, being too prescriptive about where true valuations lie is really a crystal ball gazing exercise at the moment, because the earnings trajectory you're seeing out of every one of these companies that's issuing in the AI space right now is just going up and up. And we would not have forecast quite what we're seeing today 6 months ago. Let's see what we're going to see in 6 months from now.
Can you hedge against this trend? Does it pay to?
I don't think so. I think if this falls off the tracks, all markets are going to sort of correlate to one. So I think this is such a momentum trade that if we lose enthusiasm or belief in the AI trade, that is partly driven by the fact that we can all see it. Your organization, my organization, all of the businesses out there are trying to reconfigure their business model. So we're buying into this wholly at every level of the industrial footprint, if you like. And if this falls off the tracks, I think you're going to see a major market correction. God willing, we won't be there.
As you note, the leadership is so narrow with these specific stocks. Do you see any momentum or catalyst for it to broaden out?
You would hope so. You would hope so, because that would be a healthier market trend. But actually, at the moment, if you're an active manager or a passive manager in this space, you know where the growth is coming from, and you know that the current earnings season is only going to enthuse you more. So, you know, we haven't even touched on Iran and what's going on in the real world. And if you sort of broaden your reach out to inflation and rates and how companies are going to deal with tariff problems, what's going to happen to energy and energy pricing with this AI rollout, all of that would make you feel a little less bullish about sort of the broader marketplace. And at the moment, I think the one trade that everybody's following is in that narrow band, and we're going to see that continue in the near term anyway.
Well, that's where all the optimism is. We're 10 minutes into the program. Maybe we should talk about Iran. There's no deal in sight at the moment. Very different readouts between Israel and the United States in terms of what's happening. If we remain in this paralysis till the end of the year, what is going to be the risk and the impact?
Well, look, there's a lot of clever analysts that will tell you that June 30th was quite a big date for certainly gas restocking. If you look at just the European gas supply levels or holding levels right now, they're at about 40%, when normally at this time of year they would be at 55% of what you need to get you through the kind of winter months. So we're lagging. 30th of June was a big date because that's when you get the big restock for winter periods occurring in places like China, in places like Europe. So we are going to be lagging going into the winter. That seems like a reasonable assumption. And that could lead, depending on who you listen to, either mild disruption, which ultimately is what we saw after in 2022 when Russia invaded Ukraine and Europe had similar issues with fuel supply, to really severe disruption, depending on how long this goes on for. We all believe that all parties are motivated to find a solution. So we're clinging on for that for now. But every week that goes past, we've got to adjust that assumption as we see new news feeds. I'm afraid the wider financial market just isn't focused on this right now. It's all about AI.
And yet they haven't found one. Motivated, but haven't found one. Martin, it's good to see you. It always is. Thank you, sir. Martin Horne there of Barings. You've said this a million times, Bramo. You can't have an edge on this topic, so people started ignoring it. And they focused minds on what was happening in technology, high conviction bets. I've asked the question, has tech rallied despite the situation in the Middle East or because of the situation in the Middle East? And the response I've had is maybe both. Yeah, on one hand, you have, of course, really good earnings, which is the reason why people are going on in spite of what's going on in the Middle East. But it also is the one isolated reality that really doesn't have some sort of linchpin in the Middle East, which means it's analyzable and potentially you can get an edge, which is the reason why people view it as such a refreshing trade versus saying, will they or won't they? In the Strait of Hormuz. We'll play that game in just a moment. Will they or won't they? Just about pulling back from record highs this morning, down 0.1% on the S&P, with an update on stories worldwide. With your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. We are seeing Hewlett-Packard Enterprise shares rising 25% in the pre-market. The company forecasting a bigger than expected sales jump for this year and next, citing strong demand for its AI servers and networking. Anthropic moving ahead in the AI race, filing for an IPO ahead of rival OpenAI. The company saying in a blog post that the number of shares to be offered and the price have not yet been set. And the cost of competing in AI keeps climbing. Alphabet is raising $80 billion through a package of equity offerings, including an investment deal with Berkshire Hathaway. The company plans to use the money to build infrastructure for artificial intelligence and meet soaring demand for its chips. That's your Bloomberg brief. John.
Yahira, thank you. Thanks for the update. More from Yahira in about 30 minutes' time. Up next on the programme, peace talks hitting a wall.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. They come to the table. They're begging to make a deal. They want to make a deal badly, and we'll see if we get there.
There was a moment in the last 24 hours where it felt like trade talks from 8 years ago. Talks are on. Talks are off. Talks are on. Talks are off. That was the last 24 hours.
Yeah, and from Iran, talks are off. The U.S. talks are on. Iran, not so sure. The U.S., yes, they are. Israel, we're still doing our thing. The U.S., everyone's in peace. I mean, it's sort of this curious moment.
The deal's coming. Up next, Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. Eight-day winning run on the S&P 500 this morning. This morning, we're throwing a lot at this equity market, an $80 billion equity capital raise from Alphabet. That stock is only down by 2% this morning. Futures are negative by just 0.1%. The more bullish side of the story, I guess, is Berkshire Hathaway, sitting on a major cash pile. Signs over the last week or so, two major signs. They're starting to put some of that cash to work under new leadership.
Greg Abel is making his stamp known, and this comes after he took the helm. These are his first big purchases. On one hand, you have Berkshire Hathaway going after a home building company at a time when they're expecting, I'm sure, some policy response to the affordable housing crisis, and then going after getting a stake in the tech build out. This is notably a departure from Warren Buffett, who really stayed away from some of the tech build out. Does this invite everybody else to come in? Does this indicate a dearth of other opportunities? Or does this indicate that sitting on cash is going to be an ultimate problem given the fact that we're in an inflationary moment?
So there are plenty of bearish angles on the Alphabet story, and we'll cover them extensively. Don't worry about that. But the bullish angle, we're deploying $400 billion of cash potentially, at least a little bit here and there, and you want to be bearish? Right now, that would be the bullish angle to this story.
And the bulls are winning, because if you're a bear, how are you going to hedge and how are you going to keep your money and what are you going to tell your investors when you're far, far behind? We were just talking with the guy from Barings who basically said there's no way to hedge against this. And if you do, it's not clear that it's actually going to be a hedge, because if you do get some sort of break in this story about the AI build out, everything's going to correlate to one and everything's going to go down. So you either get on the train or you get steamrolled over. And ultimately, that's where everyone is.
Check out the bond market this morning. Yields a little bit lower. We're down a basis point or two at the front end of the curve, 4.01%. Kind of anchored around 4 more recently. Off the back of this move in crude yesterday, higher, now lower, just by a touch. We're down 1% on Brent to $94 a barrel. Under surveillance this morning, peace talks hitting a wall.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We have to have a deal that's acceptable to me. They come to the table. They're begging to make a deal. They want to make a deal badly, and we'll see if we get there.
They think that they are getting very close to making a deal.
So here's the latest this morning. The president holding an expletive-filled call with the Israeli Prime Minister Benjamin Netanyahu. According to Axios, Trump calling Netanyahu crazy as Israeli strikes in Lebanon weigh on peace talks with Iran. Bloomberg's Tyler Kendall joins us now for more. Tyler, good morning.
Hey, John, good morning. Well, this reporting goes on to say that President Trump's anger seemed to be primarily driven by the fact that the escalation in Lebanon was risking derailing the U.S.-Iran peace negotiations. Keep in mind, Israel is not a party to those talks, but Iran has repeatedly maintained that a ceasefire in Lebanon needs to be part of any deal. And that prompted President Trump to get personally involved in the diplomacy, holding this reportedly tense call with Netanyahu, as well as a separate conversation with representatives of Hezbollah. After that, he said that both sides did agree to stop firing on each other and that then the U.S.-Iran talks were proceeding at a, quote, rapid pace. Israeli Prime Minister Netanyahu did confirm that Israel was planning to hold off on some planned strikes near Beirut in response to Hezbollah firing nearly 300 projectiles in recent days. But he said otherwise, the Israeli campaign in southern Lebanon would continue. It marks just the latest friction point in the ongoing negotiations. But John, it's also probably worth pointing out for context here, before the conflict started, the U.S. wanted to see Iran stop its support of proxy militia groups like Hezbollah, but at the moment, that doesn't seem to be part of the ongoing conversation. In fact, yesterday, Iranian state media reported that the, quote, axis of resistance would be activated on all fronts in reference to the militia groups that it supports, and threatened that its proxies in Yemen could move to close another vital shipping route off of the coast of the southern Red Sea by utilizing some of those proxies in Yemen.
That's the last thing we need. Tyler, thank you. Tyler Kendall down in Washington, D.C. To build on this conversation, Colonel Wayne Sanders of Bloomberg Intelligence. Colonel, welcome to the program. I won't pretend to know where we are in negotiations. Let's focus on something where we have some visibility. How many ships are actually getting through the Strait of Hormuz right now? Because it just feels to me there's a bit of drip feed picking up here, there and everywhere in the past few days.
Yeah, absolutely. I think the U.S. CENTCOM and Fifth Fleet are really trying to be able to provide additional flexibility for these, right? They're still from the way that they're looking at it right now is anything that is Iran-based, they're still not letting through. But in terms of an increase in some of the momentum, you're actually starting to see some of that throughout the Strait. So we know that that part is actually good, but there's always going to be that threat. Just like Tyler was talking about, you're still going to continue to see potential threat from axis of escalation at this point in time.
Well, I have a question here. What is the basis right now the U.S. is trying to negotiate? Is it the nuclear deal in your mind, or is it just minimum to get the Strait of Hormuz open? And do you think they'd be willing to ease up the blockade in order to do that?
Yeah, I think that they would do it from a phased approach. If they can actually get the Strait of Hormuz open at that point in time, and even if they said, OK, I need 30 days or 60 days to reach an additional part of the nuclear deal, what I think they're trying to do is increase the amount of momentum to be able to move the straits open, right? It's been closed for so long. It's been so restricted. And insurance has gone up. Everything else that's gone along with that has played into. So a lot of the political and information side of the House is playing into that military piece of it. So it is probably one of the biggest levers, though, that the U.S. has is to hold on to the blockade to make sure that Iran cannot get any of their oil in or out. And so you're seeing that even from Qasem Island. You see that as part of Karg Island and some of the additional, even the military posturing in the area, both from Iran and from us.
There's the proxies, there's the firing on U.S. forces in the Strait of Hormuz. It's not letting certain ships through. It's claiming, the Iranians, that negotiations are off. What is it going to take potentially for this administration to say, you know what, they are off and we're ending the ceasefire?
Yeah, I think the U.S. doesn't want to be the ones that actually do it. I was actually a little surprised when Iran fired this weekend and actually injured some U.S. soldiers. I thought there may have been a response. I thought that by Monday morning, we probably would have seen something, maybe not a large escalation, not something that brings us out of the ceasefire, but more than what you've seen from Fifth Fleet and CENTCOM so far against Qasem Island strikes and some of the other ones in the area. They've kept that right now as pretty much a self-defense measure, saying, hey, look, you shot at U.S. bases, you've shot at Gulf state allies of ours, and they look at that as an imminent threat, so we are going to return fire, as opposed to putting something into place that says, I am going to actually strike strategic targets that has a larger center of gravity impact to you.
Colonel Sanders, who is President Trump negotiating with?
So I love this question because, depending on who you're talking to at the day, right, you have the balance of power in Iran right now is you still have the presidency, you still have the supreme allied leader, you still have the head of the IRGC, and you also have the Supreme National Council. So you have these four instruments of power at that point in time. And so this becomes one of the biggest pieces that's so difficult right now is you could be talking to somebody within the presidency side of the House as part of the foreign minister and have those discussions go, everything is going really, really well. And then you have an IRGC commander that launches a couple of Fatah 110 ballistic missiles against a Gulf state, and it starts to degrade the ability and legitimacy of one of the other heads to be able to make that deal. So really, you're looking at trying almost like a four-headed hydra that you have to address all at the same time to get all four of them in place at the same time to be able to reach this agreement.
Colonel, appreciate your time. As always, sir, thank you. Colonel Wayne Sanders of Bloomberg Intelligence. That question is the right question.
A four-headed hydra, that's who he's negotiating with. It's a difficult moment. People are tuning out because how do you understand these different headlines that are changing by the hour and really have a different tone depending on which branch of the four-headed hydra it's coming out of?
I often reflect on the ghost call with China of several years ago. Important because it signaled intent. Not because it happened or it didn't happen, but it signaled intent. The president wanted to bring down the pressure, the volume, the noise. There's more than one party in this negotiation. It was never the same as the trade story of a year ago, 8 years ago.
Can people ignore it in the same kind of way and just take the signal and not necessarily the fact?
Futures this morning pulling back by just 0.1%. Up next, we'll catch up with Ted Mortonson of Baird as Anthropic pulls ahead in the race to IPO. Live from New York City this morning. Good morning to you all. 8-day winning streak on the S&P 500. Just a small pullback. We're down by 0.1% on the S&P 500 and just about unchanged on the Nasdaq. If you saw that picture, you really wouldn't have a clue about the news flow of the last 24 hours. That $80 billion equity capital raise from Alphabet is an absolute monster.
If you get a sense of it, some perspective, the SpaceX IPO is planning to raise $75 billion of cash in this nearly $2 trillion IPO. This is bigger than that, as you just pointed out, which is notable given that we already are going to get a whole host of other IPOs sold over the next couple of months ahead. We're talking about Anthropic. We're talking about SpaceX. You put this all together, the market is Teflon. The market is saying, if you want to come to market, the time is now. And ultimately, whether it's Iran, whether it's the glut, whether it's concerns about inflation, it doesn't matter, because ultimately this market very much wants to get invested in AI.
And when you look at these numbers, where are they putting this money to? It's TPUs. They're in that market, which is potentially going to take share from NVIDIA, or at least be a serious competitor. But they are also a serious competitor when it comes to likes of OpenAI and Anthropic, which are all trying to get to market as well. Google is all over the map. This is to build data centers, and this is for more compute as been deep.
There's a tax bill in the mix as well. We'll spend some time on that later. The stock is down by about 2% in the pre-markets. We count you down to the opening bell, 3 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Following Dell's blowout results, the bar was pretty high for HPE, and it managed to clear it with room to spare. Shares are soaring more than 25% in the pre-market after it raised its outlook significantly, pointing to massive demand for its AI servers. And it was so confident about the demand backdrop that it even issued an early outlook for 2027, well ahead of Wall Street estimates. Meanwhile, Jensen Huang still over in Taipei and still moving markets. The latest is Marvell. Shares also soaring more than 25% in the pre-market after the NVIDIA CEO called the firm the next trillion-dollar company while on stage with its CEO. But Wang, not exactly a neutral observer here. Earlier this year, NVIDIA did disclose a $2 billion investment in Marvell as they work together on things like custom AI chips and networking technology. And ahead of its earnings tomorrow, we are seeing the chip maker Broadcom shares soar nearly 7% in the pre-market after HSBC raised its price target to $600 and said the next leg of growth may be right around the corner. Frankly, over at HSBC, expecting custom AI chip revenue to inflect higher in the second half of this year due to increased spending from none other than Alphabet, OpenAI, and Anthropic. John?
Yahara, thank you. Thanks for the update. Jensen on tour, got to Alaska, got an Air Force One, never came back from Asia, did he? That was a few weeks ago. I don't think he left.
Well, he's doing pretty well over there. I mean, honestly, his chips are made over there, and he's got some business.
He likes the street food. He's out and about with the people. Yeah.
He's having a great time. All right. On our radar this morning, the big one, Alphabet raising $80 billion in equity to fund an unprecedented AI spending spree. The three-part deal is one of the largest of all time. The package, including a $10 billion share sale to Berkshire Hathaway. Berkshire already holding nearly 40 million shares of Alphabet as the new CEO, Greg Abel, increasingly leans into tech and AI and starts deploying that $400 billion cash pile. And finally, Anthropic confidentially submitting paperwork for its IPO. The AI giant aiming to beat rival OpenAI to the market. The price and number of shares to be offered unannounced. Anthropic's valuation sitting close to $1 trillion.
When you ask analysts, they say they're racing. When you ask them, we're not racing. We just are going to keep our options open. Yesterday, we heard from Sam Altman, Dario Amodei talking about how it just could be a good time. Nonetheless, both of them want to set the tone. Ultimately, the one who gets in first is going to have more of a carte blanche to get a sense, A, of how much money is out there, B, tap into the enthusiasm, and C, get ahead of any snafus that the other guy might make. I know that right now it seems like Anthropic has the edge. Does that really increase the impetus for OpenAI to kind of gun it to market first? And how long will this market remain so wide open?
Isn't this surprising, though, that Anthropic gets there first? Before this year, everyone was saying it was going to be OpenAI. And Anthropic was really the underdog. And now they've pretty much overtaken OpenAI in terms of where everyone is, the excitement is, where everyone wants to know more about the compute and the models like Mythos. They're ahead of OpenAI, but it is too early, I guess, to say.
I was listening to Altman yesterday with Faber. Thought he did a fantastic job. For Altman himself, it was interesting how much daylight he's starting to put between him and Amodei when it comes to talking about the future of this technology and what it might do to society. I have to say I prefer his version of the future. compared to Anthropic's, but increasingly putting some daylight between the two companies.
And putting a little bit of daylight between himself now and himself maybe 2 years ago.
Indeed.
So it clearly is a PR move to try to put a little bit of a warm and fuzzy approach, given how much pushback there's actually been. I just think if anyone needs vibe coding, a use for their tokens, if they need to get up the leaderboard to make sure that they're really deploying it.
You've got ideas.
Yes, please. I think a biopic or, just a sort of interesting look at the rivalry between Sam Altman and Dario Amodei.
The movie?
The movie. It could be them as fruit, whatever you want to do. I think it would be very well received.
The better will be Sam Altman versus Elon Musk, besties to bitter enemies.
Them as fruit. Okay, I think that's what you said, right? Yes.
No, mine
okay.
are humans.
Okay, all right, good to know, guys. That's the definition of AI slop, right? Yes, Bramo can't keep it together. OK, let's move on. Ted Mortonson of Baird writing Anthropic represents the new, an enterprise AI operating layer for knowledge work and software development. Ted joins us now for more. Ted, good morning. It's good to see you in person. Thanks for being here. Is there enough space for everyone?
There is in this cycle. This is not even close to the 2000 cycle. The only comparison is animal spirits. But this is a major infrastructure rollout, nothing that we've seen in my lifetime.
Unpack some of that for us. How much runway do you think there is here, and why?
Oh, geez, I think you're talking anywhere from 5 to 10 years. The infrastructure comes first, software comes second. And Anthropic is one of the most disruptive companies. You don't see companies going from 9 billion to 47 billion in revenues in less than a year. I mean, that's eye-popping.
That said, do we have a sense of exactly what world this is building? In other words, if this is that disruptive and all of these dollars are going to projects that are worth it, how transformative is this going to be in a way that people really are not wrapping their heads around?
The AI stacks are totally different from what traditional SaaS or software was. I mean, this is a forklift upgrade, not only on infrastructure, but software. And they're not tied together. I mean, infrastructure's first, software's second. But what Anthropic has done is they've not only created this market for coding, which now for a software company, your cost of goods sold goes basically to zero. That's number one. So there's huge operating margin leverage. Second of all, just this knowledge work. If you haven't used Claude, you should, because it will change the way you go about your business almost every single day. It makes you so much more productive. So it's very disruptive. The difference between OpenAI and Anthropic is, if you look at OpenAI, they chose to go consumer. And Anthropic is all enterprise, and that's where the money is.
Does it matter who goes first?
I think it's important to get through the window, because you never know when the window is going to be shut on your hands, on your fingers. You just...
Did Alphabet just go first?
Yeah, they went first, and that surprised a bunch of my clients. I mean, but that's what's important. The $80 billion basically extends this cycle through 27, just on CapEx. If you're a cloud titan, you know, what Google's saying is, hey, we need augmentation from our free cash flow. So 80 billion is a big number. And then you combine all these other offerings that are coming. The infrastructure build is going to go through 27 pretty aggressively.
When it comes to Anthropic, you say they focus on enterprise, while OpenAI was focusing more on consumer. How can you be an offering for enterprise if you are labeled a security threat by the DoD? No, seriously, is this not at some point going to hurt them?
It could. The narrative will be sculpted in the next few months, but Mythos was a big deal. I mean, when Jerome Powell and Secretary Bessent call an emergency meeting on a Friday and get Glasswing, what's called Glasswing, the vendors together, I mean, talk about an eye-opening experience. And that's why Palo Alto and CrowdStrike are straight up. There are other small cap companies like Tenable that fit into that Glasswing security issue. This is opening up a whole different total addressable market.
Do you think then the government's going to have to find other inputs that aren't Anthropic because of the supply chain risks that the DoD labeled it? Or do you think at some point the DoD is going to have to lift their hands and say, we have no choice, we're going to have to work with them?
I think it's B.
B, wow. Okay, so so basically Pete Hegseth and Emil Michael say you won.
I think there's going to be a cooling off period, and this is a national defense issue. You cannot have them sitting on the outside.
Ted, can I ask you where you think the money's going to be made? I don't know what the sequencing looks like here.
Yeah,
clearly,
that's a good question.
The chip players right now are making all the money, but when you describe the sequencing over the next 10 years or so, infrastructure, then software, where do you think the money will be made?
I think it's going to be in some specific software companies that are consumption-based. I mean, you've already seen it through Datadog. You've seen it through Snowflake. I mean, these stocks are straight up because of consumption adoption of what I call the new versus the old. So from a software perspective, I think what the street misses is these free cash flow, software names, free cash flow, much better than some of the infrastructure names. So over the long term, the software names that get that foothold are going to be absolutely money machines. So it's going to take a while for that infrastructure to pivot, but we're going to see some new software companies just like we saw new software companies in the 2000 cycle.
Who's losing here? Who's not keeping up and likely to fail?
I think it's the smaller cap companies that are features. They don't have the free cash flow. They don't have the engineers. They don't have the scale. The other area would be and it's well known, the SaaS companies have to pivot. I mean, when you have revenues that are 90% SaaS and 10% consumption, that pivot is ugly. And for my institutional clients on the software side, the reason why the IGV was down 30% at one point was just because nobody could work through their models on that transition between SaaS and consumption, and they couldn't get to a free cash flow number. So if you can't get to a free cash flow number, how do you put a multiple on a stock? Now, it's getting much clearer. I think some of the checks coming out of Salesforce on Agentforce are getting a lot better. Even Workday, which nobody's really focused on, it's kind of a value name. I'm on 70-plus conference calls during an earnings season. It's like the Baton Death March. Workday actually talked up their agent momentum. Nobody's paying attention. You got to listen to these calls. So they'll get there over time. And as they pivot, the free cash flow expands.
Ted, just final line of questioning from us. We're laser focused on potential capital constraints. No sign of pushback in the debt market, not for the likes of Alphabet. They've just gone on a $60 billion 4-month debt binge. No sign of pushback in the equity market, not for Alphabet again this morning. They're looking to raise $80 billion in equity capital and the stock's only down by 2%. You seeing any signs of that emerging? Any pushback, any capital constraints anywhere?
Yes.
Where do you see it?
I see it on the debt side. Why do you think all these companies got to go public? They can't raise it in the debt markets, whether it be private or in the normal debt markets. The numbers are too big. That's why on a capital side, they've got to go public. And where my big concern is, and again, is listening to a lot of companies, is inflation is straight up in the tech area. You listened to HP last night. They're not only facing shortages, but they're passing on tremendous price increases. And the enterprise companies, call it the Global 2000, their IT budgets are up 3 to 4%. Do you think they can absorb, a 10 to 20% price increase on a server? The answer is no. So I think there's going to be an issue with inflation, and I'd watch the 10-year very closely.
So final question then on inflation, and we can talk about the bond market.
Yep.
But just final question on the pushback that we might see. Do you see that ending in softer demand, or do you see that ending with cuts to operational expenses elsewhere? How does a company respond to those high prices?
They go to refurbished markets. I don't think the street is focused on the enterprise at all. They're hurting on price increases. I mean, they have to upgrade all their infrastructure over the next 5 years, networking to storage. I mean, they're somewhat IT constrained. What's fueling this market is the cloud titans. And it's going to go for a while just because of that Google news last night. I mean, you just put gas on a fire. So,
just to wrap it up, because a lot of people want to know, you said watch the 10-year. What are you expecting to happen?
I think personally, this is just my personal opinion.
Please go for it.
It's not the firm's opinion. I think that we're going to lose control of the long end. And if the 10-year goes through 5%, I think there's going to be a lot of portfolio managers that look at multiples and try to figure out. I mean, war is very inflationary, by the way. And now we've got one of the biggest cycles in history where we've got over, call it $735 billion of spend. And the supply chain can't absorb this. So the only thing, if you look at the memory shortages, they've got to pass it on. And I think the inflation inputs in tech are only up. They're not down. So that's going to flow into some of the data, and I think it's really going to surprise some people.
I could speak to you for hours. Ted, it's good to see you.
Okay.
Thank you, sir.
Thank
you very much. Ted Mortonson there of Baird with a interesting note at the end there on the bond market.
Ultimately, if you have existential spending, and you have this much existential spending, you have it in wartime, you have it in technological build-outs, you have to imagine that's going to come in some sort of ramification when it comes to inflation.
10s this morning, 4:43. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Secretary of State Marco Rubio testifying on Capitol Hill today for the first time since the start of the war in Iran. His testimony comes as a growing number of Republicans question the price and economic impact of the war. Speaking of, President Trump and Israel Prime Minister Netanyahu offering differing accounts of their call about Lebanon. Trump using a social media post to tout an agreement between Israel and Hezbollah. Netanyahu saying military action in southern Lebanon will continue. The White House says it will reduce tariffs on agricultural equipment to cut costs for U.S. farmers and manufacturers. Levies will drop to 15% from 25% from next week until the end of the year. President Trump citing rising costs as a justification for the cut. That's your brief. John.
Hey, Yahira, thank you. Thanks for the update. Up next on the program, the Fed holding steady.
Our base case view is that the Fed is likely on hold. We think that they're on hold through the middle of next year, and then it's going to be data dependent.
Kit Juckes of SocGen just around the corner. Eight-day winning streak this morning, pulling back by just 0.2% on the S&P, down a tenth on the Nasdaq. On the Russell this morning, down by 0.15. Under surveillance this morning, the Fed holding steady.
Our base case view is that the Fed is likely on hold. We've seen a huge shift in expectations. We never believed that the 2 or 3 cuts that we were expecting at the beginning of the year. We don't believe we're going to see the hikes that markets are now pricing. The Fed's going to be on a wait-and-see mode. We think that they're on hold through the middle of next year, and then it's going to be data dependent.
So here's the latest this morning. US manufacturing activity expanding at its fastest pace in 4 years. Investors are waiting more data to reinforce bets on the path for interest rates. Kit Juckes of SocGen writing, while President Trump's hopes for Fed easing may be disappointed, hikes are off the table for now. Kit Juckes joins us for more. Kit, welcome to the programme, buddy. Good to see you. My apologies about the result over the weekend. I'll squeeze that into the end of the conversation, Kit. How high is that bar for that rate hike of this Federal Reserve?
It seems very high now. It's not going to feel so high in 6, 9, 12 months' time. I think the world will eventually change. Look, the US economy is, without doubt, not just outgrowing the rest of the world, but it's growing pretty strongly.
If that's the case, Kit, what is the barrier to potentially raising rates, and not just once, but several times? And we were just talking to somebody talking about how he sees the 10-year yield getting unmoored with all of the capital spending from big tech giants. We're seeing inflationary pressures coming from myriad different places. I mean, would it be a problem if they hiked rates?
Well, if you leave it too long and you hike rates too much, too fast, too late, then that is a recipe for a recession. Equally, I almost want to flip it sideways over here, where the danger is with the slowing economies. We're going to raise rates. The market thinks we're going to raise rates at the ECB several times, which seems to me a sort of a quicker way to a problem. But yeah, I think that I've always assumed the Fed's smart enough that they don't get too far behind the curve, and that what we'll find is that the story just changes through time, and that one of the things about Kevin Warsh now turning up and being there will be that it'll be possible to turn that story around, make it clear that this economy is doing better than others, the terms of trade shocks in its favor. Obviously, the technology boom is still happening, and gradually there'll be a rethink.
If that's the case, I'm wondering if you push that through the currency channel, what that means. If you have rate hikes that are a mistake, in your view, from the ECB, they could potentially create an economic problem, and you have a U.S. economy going strong and a Federal Reserve that sits on its hands, do you want to own the dollar or do you want to sell it?
I want to own it. I mean, I'm not relaxed about it, but I get asked, why, if we think that rates are going to go up in Europe, why don't I want to own the euro? because they're going up despite there not being enough growth. And fundamentally, that's the issue, that tightening into weak growth environments is just going to make things worse. Whereas in the United States, what's holding me back is a central bank that doesn't recognize the problem at hand. But they'll get there because that's the kind of organization it is. There's a lot of people on the FOMC, a lot of regional governors who will react to what they see in front of them with the economy. And I think in due course, that's going to argue that, yeah, we're at neutral, not at super easy policy, but we need to be better than that. Numbers like this morning's, they just push in that direction.
Kit, though, there was an ECB report that says gold replaces U.S. Treasuries as the world's top reserve asset. Are you worried about de-dollarization?
At the margin, I mean, the dollar's been the world's reserve currency to a much greater degree and for longer than, for example, the pound was. So that the global economy is so dependent on it that we get de-dollarization at the margin, in the same way as that there's not enough gold in the world to replace a fraction of the U.S. treasuries that people might want to own instead. So, yeah, at the margin, there'll be some of that, and the dollar will be less dominant, but it'll probably still be more dominant than sterling was 150 years ago.
What does the ECB have in common with Arsenal Football Club, Kit?
That they are too defensive. That's the fundamental issue in my heart. That their game plan isn't going to win them the Champions League. That's probably the quick way of putting it. The U.S. the Fed is much more like Paris Saint-Germain. And in the end, this could be long drawn out. It could be painful. It could go to extra time and to penalties. But I don't think the ECB can win this with premature tightening and such a defensive strategy.
The parallels are extraordinary. They really are. Kit, thank you, sir. We appreciate it. You're a good sport. Kit Juckes there of SocGen. In Kit's note, in the last 24 hours, Arsenal played football like the ECB are set to run monetary policy. 25% possession on Saturday. 25 basis point rate hike coming in a week's time, apparently.
Yeah, defensive strategy that was ultimately doomed. And ultimately, I will say, if the U.S. is like PSG, then we're at least not rioting the day after. Though there is a sense right now that maybe the ECB is in a pretty negative position and the U.S. is sort of in a good spot. His point, though, if the Fed doesn't hike soon enough, it could actually have a problem on its hands that could potentially lead them to them raising rates too quickly and cause a recession.
I'm surprised at the ECB. I really am, because they've made this mistake before. They made this mistake once, then twice under Trichet. And it's interesting to me that they're so keen on making it again.
If they have a desire to avoid that mistake, at what point do they become a dual mandate central bank? If they truly are a single mandate central bank, they will be doomed to make this mistake in any kind of supply side shock. And ultimately, that is what they're facing right now.
And that's the new era. That's the new era we've been in ever since the pandemic. Equity futures this morning pulling back by not even 0.2% on the S&P 500. So much to cover in a world of tech. We've got an $80 billion equity raise over at Alphabet. Anthropic moving forward with an IPO potentially as soon as the next several months. And then you've got stocks like HPE absolutely flying in the pre-market. Up next, we'll catch up with Evan Brown of UBS, Momei Qu of PSP Growth, Daan Struyven of Goldman Sachs, Neil Dutta of Renmac. The second hour of Bloomberg Surveillance just around the corner.
This economy really is on fire.
Growth is very solid for the foreseeable future.
It's actually one of the healthiest labor markets I've seen in decades.
We've underestimated how less rate sensitive we are.
The Fed is really well positioned here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. An 8-day winning run on the S&P 500, the longest daily winning streak of the year so far. This morning, we're down by 0.2% on the S&P 500. On the Nasdaq, we're down 0.1. Tech stocks in focus. One stock in focus, Alphabet, an $80 billion equity capital raise. Berkshire Hathaway getting in on the act. Alphabet down 2% of the pre-market.
Which is nothing when you take a look at the nearly 120% gain over the past 12 months for these particular shares. This would be one of the biggest capital raises ever in the equity markets following the $75 billion SpaceX money raise that is expected at any time with their nearly $2 trillion IPO. And it comes ahead of, and you pointed this out, Anthropic potentially, as well as OpenAI. What does it say about where we are in markets? And that, I think, is increasingly what we're hearing from strategists. It means that the window is open and you need to climb through that window as quickly as you can before it slams shut. Does it have any signs of slamming shut? Not yet. But why not get in while the getting is good?
But the character of the US equity market is changing. It's changing. We've gone from capital returns in this dominant weighting on the S&P 500 to capex intensity rising. We've gone from shrinkage to supply in the equity market, and not just the issuance from Alphabet, but also the IPOs lined up for the next 12 months. Things are changing, and they're changing fast.
Ted Mortonson said the reason why they're tapping the stock market is because, frankly, it's a better option for them. They're getting too big to raise it just in the debt markets. And even though the debt markets are wide open, and boy, are they when you talk to anybody, they are starting to put a little bit more constraints. People are looking for different security or secured assets. They're having a shorter time frame, maybe 5 years rather than 10 or 30 years. Equity is a perpetuity type of instrument. So they're saying this is the time to do it. When does it pay off? Can you hedge? All of these questions that are existential, the answer is you can't think about it. You just do what Chris Verone does. The less you know, and you buy.
Well, Alphabet's saying this is an expansionary moment. And right now, what they are doing in terms of AI solutions, services from enterprise to consumers, in their statement, they're at levels that are exceeding the company's available supply. Bloomberg Intelligence is now saying we're looking at $300 billion in CapEx next year. So this train, that continues at least for another year and a half.
Think about that quote from the CEO a few summers ago. The biggest risk here is underinvesting, not overinvesting. That was a CEO confronting what he believed was existential risk. And he's piling into this by raising more money. $60 billion raised in the debt market worldwide in 4 months. That only just wrapped up, and now going into the equity market for another $80 billion. And there's still more appetite for the next 12 months and the 12 months after that, and so on and so forth.
When you look at the trillions of dollars that are probably going to be necessary over the next couple of years to finance the build-out that people are talking about, they're talking about data supplies, they're talking about TPUs, GPUs, the production of it, the staff to really recreate all of the software, the education to go into all of the companies and figure out exactly how to do this, the energy production and all of the assets. It is incredibly capital intensive. Now we have to say, what is going to be the ramification for the economy? Is this going to create efficiencies? Is this going to be inflationary? We're talking to Torsten Slok saying that it is going to be inflationary. And if so, who's going to pay the bill? Will there be failures in terms of other companies? Or ultimately, do prices just keep rising at pace, leaving a problem for the debt market?
Well, I think we framed this a few times in a way that I think Ted Mortonson's thinking about things anyway. You've got all these companies, some of the richest on the planet, by the way, tapping the debt market, tapping the equity market, raising capital, and then pushing it into a supply-constrained economy. One that has seen negative supply shocks across goods, labor, energy, and everybody's talking about bottlenecks. Well, they're not backing away, are they, with higher prices? They're going in for even more and spending even more. And you'd have to believe that comes with some inflation. How much inflation we get in the next 12 months, I don't know, but certainly some inflation. And Ted was talking about that being a risk to the bond market. Inflation being one and crowding out being two. And that's something we've got to think about as well.
If companies need to completely recreate their entire infrastructure, they're going to have to raise prices, or else they're going to have to accept much smaller margins. Who's going to pay those higher prices?
Alphabet this morning down just 2%, which is remarkable. Just speaks to the amount of demand out there in this equity market still. Coming up this hour, we'll catch up with Evan Brown of UBS as Anthropic takes steps to go public. We'll speak to Momei Qu of PSP Growth as Alphabet looks to raise $80 billion. And Neil Dutta of Renmark as the Fed prepares to drop its easing bias. We begin this hour as some of the world's biggest tech companies are preparing to tap the equity market. Evan Brown of UBS Asset Management writing, there's growing need for funding among the AI giants, and we can see there's no shortage of interest in investors to participate in the theme. Evan joins us now for more. Evan, good morning.
Good morning.
Can you sit this out?
I think you have to be invested. I mean, ultimately, I think we're still early stages in this AI build-out. Adoption is relatively low for consumers and businesses compared to where we think it can get. At the same time, you don't want to forget the other areas of the market. I think it's encouraging that as concentrated as the market has been, we're starting to see other areas like software rebound, and the discussion is becoming a little bit more nuanced on that theme.
When you have a company like Alphabet, you don't have to speak to them specifically, but just for example, just so we can navigate this conversation without you getting in trouble. When you have a company like Alphabet choosing to tap the equity market after aggressively going through the debt market in the last few months, what does that tell you about valuations, if anything?
Well, I think it just speaks the sheer demand for funding of these Mag 7 companies, that they're tapping the debt market and the equity market, and really transforming from capital light to capital intensive, shows you just what an imbalance there is in the supply and demand for compute. But I think the market is showing you that either in debt or in equity, it's willing to finance it.
The less nice way of saying this is, are they getting it at the top? I mean, ultimately, Alphabet's really good at timing the market. They always have been in the debt space. Is this essentially them saying this is a small window before valuations plunge?
I don't know if that's the case. I mean, I think there is something strategic in the sense that we are going to get some of these big IPOs coming soon. And so if you're a major public company, maybe get in there and raise capital a little bit more beforehand. But look, this is, these are some of the most impressive companies we've seen in the market, these Mag 7 companies, and they've shown an ability to perform, and I wouldn't bet against them.
Can equity valuations keep climbing if you don't have participation from the bond market? If you don't have yields that are relatively calm, and there, continues to be, yes, inflation fears, but mostly muted ones?
Yeah, what's interesting is I think it's less about valuations right now and more about people betting on earnings. So valuations themselves don't look extraordinarily high relative to where we've been over the last few years. But part of that is because people have such optimistic views on where earnings are going to be. And so the question is, will this AI build out, will it, will the ROI really justify what people are projecting on earnings? And I think that, that remains to be seen. But at this point, it's hard to fight what we've seen in terms of Q1 earnings, and the guidance is just really, strong economy, strong outlook for these companies.
A lot of people were kind of shocked about Alphabet. Were you shocked that they came out with this massive announcement, also right before Anthropic and OpenAI buy?
I'm not shocked by any of the big numbers that we're seeing thrown around in terms of financing these days. And we think about the CapEx needs that a lot of these companies are committing to. So, I'm not surprised by it.
We just had another positive earnings shock. Not a negative one, but a positive one in HPE. Some of these single-name stock stories, what are analysts finding so difficult coming into this year? Because this is highly unusual to see beats this large. Usually analysts are accused of being overly optimistic, right? Usually, and late. They never cut their targets, their outlook in time. What's changed this year? What's going on right now with these massive beats that we're seeing across single names?
I think what we're seeing is that this AI trade and all of the bottlenecks in between, and how that's driving up pricing for key components of the build out, is something we've never seen before. Bottom line, and so I think analysts are underestimating the sheer demand that we're seeing for different components of the value chain. And, I don't know that we're going to see that in perpetuity. We've had an extraordinary Q1 earnings season, but...
Do you think we're priced for that in perpetuity?
I don't think the market right now is priced for that in perpetuity. I think the market is, upgrading its earnings cycle, the earnings projections, but not to an extreme degree.
Not to beat a dead horse, but you start thinking, what are the upside surprises in these earnings? And they come in tandem with upside revisions to CapEx plans from some of the hyperscalers and CapEx plans globally, because they're paying higher input costs. Essentially, this is an inflation story. I know that I keep harping on this, but ultimately, things are costing more, so the people who are on the receiving end of that are seeing upside surprises commensurate with how much prices are increasing, right? So you look at this and you start thinking, why does that not trickle into the rest of the market? At what point is this inflation that can be contained in this story, and at what point does it really affect your perception of the bond market?
No, I think it's the big debate was AI, is it going to be disinflationary or is it going to be inflationary? And at least right now, it is inflationary, to your point, between the rising input costs that we're seeing, between electricity prices, between software prices surging. And I think that is why you're seeing a bond market that flipped from cuts to the potential for hikes. It's not just what's happening in Iran and oil prices. We've seen oil prices come down quite a bit over the last few weeks, and we're still pricing in some probability of hikes. I think a lot of that is just the strength of underlying demand in the economy, strong nominal GDP, and a big part of that is the AI CapEx story.
Another way of asking the question, are bottlenecks in tech a reason to push the 10-year yield closer to 5%?
I mean, I think it's one part of the story of, broader parts of the story. One other one is the labor market, which we have seen stabilize. One other part is just the resilience of consumption, which we have seen, fed by the stimulus that we've gotten, tax refunds and the like. So you put all of these things together, and that speaks to an economy that's, doing much better than people expected.
You alluded to it. Even if we resolve the situation in the Middle East, is there still an argument for higher yields and not lower ones?
I think so, yes. I mean, and I think the fact that you've priced out some tightening, but you haven't priced out the tightening, as we've seen oil prices come down of late. And even if the Strait of Hormuz opens up tomorrow, I think the market will still be pricing in some probability of a hike as opposed to a cut, because we're seeing underlying strength in the economy.
Evan, it's good to see you. Thanks for being here. Thank you, buddy.
Man.
Evan Brown there of UBS Asset Management. We certainly saw that in the data just yesterday in the ISM.
Yeah, outperforming once again in terms of just manufacturing, prices paid continuing in expansionary territory, employment still in contractionary territory. Going forward, it's going to be really interesting. If the Fed were to hike rates, would it matter? Would it matter to these valuations? Increasingly, you hear not really.
What problem does it solve? Just hammers housing, right? Just hammers the part of the economy that's not doing well at the moment anyway.
Although you could argue if they raise rates, that could potentially tame the long end. I mean, at some point, it might not be an either-or type of scenario if there truly is this type of inflationary pressure.
10's right now, down 3 basis points, 4.42. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Dollar General earnings just in, and shares are up 3% in the pre-market. The discount retailer reporting first quarter earnings that beat estimates. The company reiterating plans to open about 450 new stores in the U.S. this fiscal year. Prominent short seller Andrew Left has been found guilty of securities fraud. The Citron Research founder was convicted on 13 of 17 counts and could face more than 20 years in prison. Sentencing is set for August. And NVIDIA CEO continuing his tour. He says he pays his workers as much as possible as questions grow over who benefits from the AI boom. He added he does not plan to replace them with AI, Wang dismissing those concerns as nonsense, saying AI will only boost revenue, profits, and GDP growth. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for the update. More from Yahara in 30 minutes' time. Up next on the program, skyrocketing AI demand.
Everyone on the planet will have some interaction with AI. Could I see this demand continuing much longer than people have ever seen historically? That I do believe.
Up next, we'll catch up with Momei Qu of PSP Growth, live from New York City this morning. Good morning. Equity futures pulling back from all-time highs on the S&P 500. The S&P on an 8-day winning run, the longest winning streak on a daily basis of the year so far. Equity futures down by 0.2 on the S&P, on the Nasdaq down by 0.1. Check out Alphabet. We're talking about an $80 billion equity capital raise. The stock is down just 2.5% in the pre-market. The earnings have been stellar. How many times have you heard that over the last month? Check out HPE. Crushing estimates. That stock up in the pre-market by a solid, an emphatic 25%.
I mean, it's just sort of mind-boggling when you take a look at some of the earnings beats. 31% in the fiscal year ending in October. That's a projection versus an expectation of 19%. I mean, we're talking about a 12 percentage point gap between what they actually came out with and what was projected. This is one of the largest makers of computing equipment. They have insatiable demand right now, and you are seeing that in the projections out 2 years.
This is the biggest positive earnings shock I think I've ever seen across single names and maybe the index level as well. Outside of recoveries, I think you've got to go back decades to see anything like this on the earnings front.
Yeah, you noted that analysts tend to be overbold. Nobody has a sell rating. They're not bullish enough. because we cannot wrap our heads around how quickly this is expanding.
The stock is up at a pre-market by 25%. Under surveillance this morning, skyrocketing AI demand.
Everyone on the planet will have some interaction with AI. If you think about world GDP, $130 trillion, knowledge work, white-collar work being maybe a $30 trillion market, that is a large market of which today is largely undertapped. Could I see this demand continuing much longer than people have ever seen historically? That I do believe.
So here's the latest this morning. Alphabet's raising $80 billion through a massive equity deal as Anthropic submits paperwork for its confidential IPO, filing ahead of rival OpenAI. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome to the program. The numbers are huge. What signal do you take from the timing and the size of that equity capital raise from Alphabet?
I mean, the size isn't that big of a deal given, Alphabet's market cap. It's more the signal here, which is, to me, what Google is suggesting is they won't be doing any buybacks anymore, at least for the time being. They are issuing equity because they feel the opportunity is huge and they want to pretty much front run these IPOs in the sense their CapEx numbers are going to be much bigger than what consensus has right now, which is around $250 billion. We think it'll probably be $300 billion for next year in 2027. And they want to lock in as much compute as they can in terms of getting that capacity from TSMC, where NVIDIA is paying, $120 billion in prepayments. Remember, Alphabet is not just a model provider. They're also the biggest chip maker after NVIDIA. And that's where they have a much bigger opportunity than the Anthropic and OpenAIs of the world.
Mandeep, you mentioned getting ahead of the IPOs. Are there any big public companies, maybe Microsoft, Meta, thinking about doing the same thing?
I don't think so, simply because Microsoft and Meta are reliant on NVIDIA to give them the GPUs, for their data centers. In the case of Alphabet, that's the unique value proposition they have, is they don't have to rely on NVIDIA, even though they buy NVIDIA chips, but it's more for their cloud business. And in this case, I think the market won't like it if Microsoft and Meta were to do the same, simply because of the drag on free cash flow and the earnings that you will see with more stock issuance. So from that perspective, I think Alphabet's situation is unique here, and they are trying to take advantage of their market cap as well as the position they have, across the board when it comes to the different categories.
They're certainly doing that. Mandeep, appreciate the time. What an afternoon yesterday. Mandeep Singh there of Bloomberg Intelligence. Momei Qu of PSP Growth writing the following. Berkshire is effectively putting its stamp of approval on the idea that AI is not just market hype, but a durable infrastructure shift worth funding at scale. Momei's in the studio. Momei, good morning. Good to see you.
Good morning. Good
it's
to see
great
you.
to see you in person.
You too.
Let's talk about the supply. Tons of it. Is it going to be met with a lot of demand?
I think demand is showing no signs of slowing down. And we're talking about building out essentially the railroads and the electricity grids of AI, right? So everyone's piling on. Everyone wants to grab as much as they can. This is almost like a war on oil. That's like the new compute. So I don't see demand slowing down at all.
I asked this question earlier on this morning. How much runway do you think there is here? People are wondering what innings we're in. That cliche kind of question on Wall Street. How much runway do you think there is here?
I think there's still early innings. I do think the questions will start to be asked in terms of when is the payback on this CapEx, because these numbers are staggering. I think Alphabet, or the reason they're raising this much equity, is their CapEx spend this year is going to be $200 billion. And of the Mag 7 together, I think we're talking 600, 700 billion, maybe even more, depending on what week you ask it is. And so far, no one seems to be asking, where's that return going to come from? Who is going to fund it? But I think we will soon. But the fact that people are not asking that question yet shows me that we're still in the early innings of AI, and this is just a land grab.
Demand is outstripping supply again and again and again. With HPE, we saw that as well. That really, this is an issue of just supply not being able to keep up. How much pricing power is there? I mean, can they just keep raising prices to the moon for some of these parts that are in the choke points that essentially are necessary for the build out?
It sure seems that way, doesn't it? I think you touch on an interesting point, which is where is the choke point? And I do think if you look at sort of the core suppliers, GPUs, memory, yes, like they're strictly at where the bottleneck is, and that makes sense. And I think they probably will command pricing power for quite a bit. But where I start to worry in the market is if the rally becomes broader. I could see a world where there's so much frenzy around AI that anything that even touches the supply chain gets seen as an AI beneficiary. And I think that's when you get into trouble is, I don't know if this is a good example, but data center cooling, right, is marginally touching the space, but also obviously very different than memory. I do think for the core spaces of memory and GPU, you probably see that rally go for quite a bit longer.
Yeah, like when a shoe company becomes an AI company, then potentially that raises some concerns. I just wonder, how much companies have to show return on investment going forward to keep investing at the pace that they are to rebuild their entire infrastructure, or is that not necessary yet?
Yeah, and I think in some ways, right, we can talk about the Anthropic IPO in a little bit. Seeing Anthropic's numbers could be interesting on this front. Well, first of all, we at PSP, we think about this a lot. We actually hosted an event a month ago where we gathered Fortune 500 CEOs and AI entrepreneurs together in one room and be like, what is actually valuable to being built? Like, when do you see ROI? Where is it just build? And it was probably some interesting insights there. But back to Anthropic, the interesting thing we could see from them is from the very beginning, the narrative has been about enterprise adoption. It's not just about having the best model, it's about having how do we drive actual productivity in customers. And they've done well as a result, but seeing their numbers, hopefully we will soon, will show that if retention is good, if we're continuing to see spend increase among the largest corporate spenders, then maybe AI skeptics could be a little wrong in terms of how far we are in the AI adoption curve after all.
Let's talk about the Anthropic IPO. You say it's going to be not just a massive deal in terms of being first for OpenAI, but also along the entire AI stack. What are these smaller AI companies going to be looking for?
Yeah, I think everyone will be watching them. It's going to affect the whole AI stack because essentially Anthropic is the first AI native company to go public. And they're going public at $1 trillion valuation. And there's this belief in the market that AI is going to be so much bigger than traditional software. So if traditional software is $1 trillion market globally, AI could be 10 times that, 20 times that. I've heard 50 times. Like 50 times is the highest I've heard in terms of how much bigger AI will be than traditional software. So if you're thinking there's a market that creates $50 trillion of new market cap, obviously that has implications up and across the stack. And if you look at any of the listings around top AI companies, I think Bloomberg has one that's top 24 AI companies to watch. You can look at the Forbes AI 50 as a rough proxy for what the market thinks is like the top tier AI companies. All of them are valued at least $1 billion or more, which means investors think there are going to be tens of billions, they're going to be $1 trillion, and it's every part of the stack. It's not just the models like OpenAI or Anthropic. You have AI infrastructure companies, so this is like Base 10 fell together. You have application layer companies, so this is like Synthesia, this is like Decagon, Abridge, Harvey. All these companies sitting at billions of dollars of valuations is going to be looking at Anthropic to see if the public markets will truly view AI as a different crop of companies.
Momei, it's good to see you. Thanks for being here. Thank you. Momei Qu there of PSP Growth. Remember when $1 billion used to mean something?
Yeah, billion
used to be a real number.
Billion there, trillion here, trillion there. Soon you've got real money.
It's difficult to internalize the size of some of this. Coming up, Daan Struyven of Goldman Sachs on the two-sided risk facing crude prices, plus Danny is looking at Marvell. That stock apparently could be a $1 trillion name. Equities pulling back by 0.2% on the S&P 500. Just a small dip, a small pullback from all-time highs on the S&P 500. 8-day winning streak. Can we make it day 9? Only a small drift lower on the Nasdaq. We're down by not even 0.1%. That's the story in the equity market. 2 hours away from the cash open. The opening bound just around the corner. Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Some big moves this morning despite an overall down market. HPE up 26% this morning in earnings that blew everybody out of the water for the current quarter. Its projections, which beat Wall Street expectations, even gave a glimpse into early next year, which is rare for this company. You've seen the sell side try to scramble to keep up. We've seen price target raise after price target raise. It makes networking equipment for AI data centers, so you can imagine why that's been in demand. Another AI-related story, Marvell, also surging in today's trade. Shares are up 23%. Jensen Huang is at a tech conference in Taipei Taipei, brings the CEO on stage with him and says, hey, Marvell, this is the next trillion-dollar company. That's quite the endorsement. They make networking equipment that's necessary for AI, or rather chips that allow different AI components to talk to each other, and Jensen Huang calling out those chips as especially being in high demand. Finally, decidedly not AI. It is Dollar General, also out with solid earnings. The company beating expectation, raising its forecast. The company saying, look, our value proposition is paying off, and that's why you're seeing shares up 4.5% in the pre-market, John.
Danny, thank you. Appreciate the update. Danny Berger there with some single names this morning. On our radar, Alphabet looking to raise $80 billion to fuel massive AI spending plans. The money expected to come through a package of equity offerings, including a $10 billion investment from Berkshire Hathaway. Elsewhere, Anthropic confidentially filing for an IPO, putting it ahead of OpenAI in the race to go public. The move adding to growing momentum as both companies scramble for the capital needed to secure chips and data centers. And finally, the president tearing into the Israeli prime minister. According to Axios, Trump calling Netanyahu crazy as Israeli actions in Lebanon put Iran peace talks at a standstill.
So this is some of the scuttlebutt behind the dueling messages that we heard. President Trump coming out and saying that there seemed to be some sort of ceasefire between Israel and Lebanon. Israeli Prime Minister Benjamin Netanyahu talking about how nothing has changed in their ultimate goal. A real question about what is going to be intertwined with some sort of ceasefire with Iran. And who's agreeing to what? Again, who's negotiating with who? Who's agreeing to what? Where are we? Which is the reason why this is really fun.
I mean, when John brings up the ghost call, the phantom call when it comes to China, at times it does feel like the president is almost negotiating with himself, just negotiating in public to send signals to the regime. I think the Wall Street Journal editorial board really nails it this morning. Iran's regime sees this as one war, and it's been testing Trump on all fronts. So testing him in the Strait of Hormuz, will you hang on to the ceasefire even if we're sending your troops drones? Testing him in terms of they see Lebanon and Hezbollah as part of this. So testing him there when it comes to Israel. Even as Iran is saying, we are no longer talking to you, the president is still clinging to the ceasefire, and you can see he does not want escalation.
He's committed to de-escalation. And the market picked up on that a while ago. And arguably, maybe that's kept prices in the futures market at some point along the curve more behaved than it otherwise would have been. But ultimately, I don't think you can overstate the importance of the drawdown in inventories. That's been the real cushion here that's cushioned this crude market, and things would have been a whole lot worse. How sustainable that is, get a lot of pushback to that question when we ask it. When it becomes a major problem, you'll know when you know. And when you know, it's going to be a big number on the screen.
And a lot of people are saying that you're going to know in the next couple of weeks because we're heading into driving season. That's what we heard from Mike Wirth of Chevron when he said, we're going to hit tank bottoms. You could feel shortages even here in the United States. At a certain point, you can't just keep jawboning a physicality in this world. And that essentially is the point that we're raising. This isn't fun. It's not funny. But a lot of people are looking at this and trying to say, when do we have to care? Not yet. And they keep putting it off, expecting that there will be some sort of resolution, even as this ends up being a physical problem, even if it's resolved today.
Tyler Kendall's in Washington. She joins us now for more. Tyler, welcome to the program. I remember when the Strait was reopening on April 17th. And here we are in June. Where are we now?
Well, John, at this point, it doesn't appear that we're any closer to that deal to reopen it, though we know that the White House would like that to be prioritized in any memorandum of understanding. President Trump came out yesterday and said that he was optimistic towards a deal. He said that we are now seeing a, quote, rapid pace in terms of the negotiations. But Iranian state media so far has really put out that there are still some really big sticking points, including when it comes to this waterway. We heard earlier this week Iranian state media saying that Iran would have the, quote, exclusive authority to operate the strait, something that is considered to be a non-starter by the U.S. There has been efforts by the U.S., as you well know, to help get the oil flowing through, including Bloomberg News confirming that the U.S. CENTCOM is providing information to certain vessels to help them transit through. But we're not going to see that military deployment of assets to actually physically escort tankers. I can say that satellite imagery analyzed by Bloomberg News earlier this week did indicate that about a quarter of the tankers that were backlogged have made their way through, but it has been at a trickle and is still, of course, very far below those pre-war levels. John, we'll have to see where this ultimately goes from here, because we know that the U.S. isn't going to lift up that naval blockade, give up that leverage in these conversations in order to strike a deal.
Tyler Kendall with the latest in Washington. Tyler, thank you. Crude still elevated. Brent at 94. WTI around 91. We caught up with the Chevron CEO recently, Mike Wirth, telling us and warning there may be more risks to come.
June and July are going to be critical months, and you can see the trajectory of these inventories in the data, and it's concerning. About the time that the new supplies reach the market, demand may have turned down and the price cycles down.
Dan Struyven of Goldman Sachs writing the following: we see significant upside price risk from potentially more persistent Middle East supply losses, but also meaningful price downside from weaker demand. Dan joins us now for more. Dan, good morning.
Good morning.
We'll get into the sequencing in a moment. I just want to start with the risk of this inventory story running out of oxygen. How close are we to that becoming a problem?
Yeah, so we are the most focused on tightness in the product markets rather than the crude market, in particular the diesel market. And if we were to continue to draw at the recent pace in terms of OECD commercial diesel stocks, we would hit an estimated critical inventory threshold of 20 days of demand covered by August.
By August?
In practice, I suspect we're not going to hit it because higher prices would reduce demand.
But you say August, and I'm thinking, OK, then could this go on for a bit longer, this back and forth? Can we get through another month of this, these negotiations that go nowhere?
The lower inventories go, the higher the fair value of oil prices should be. But the honest answer is we don't really have good historical evidence of what it means to go to tank bottom. So it's an empirical discovery process that the economy and markets may have to go through if the strait were to remain closed.
Where is the demand destruction going to come from? Because it hasn't come from the developed economies in any way. And frankly, politicians have been incentivizing people to continue with their habits.
Yeah, so 3 areas of surprising and large demand weakness. 1, petrochemical feedstocks. 2, global jet fuel demand. And 3, gasoline demand, especially in China, but also in several Western European countries. In China, we estimate that as of April, gasoline volume sales were down just over 20% year over year. China has reduced its imports of crude by 40% year over year. That's really, I think, a key reason why crude prices are not higher.
So do you think that people are overstating the potential for a supply shock in the next couple of weeks even, should the Strait of Hormuz continue to be closed?
I think the longer the Strait remains closed, the more inventories roll down, the higher oil prices should go. The exact sort of tipping point is uncertain. We are the most focused on the diesel market, where our models point to August as a potential inflection point.
Even in the United States, it's August for diesel?
Yes. So if you look at U.S. weekly petroleum statistics, and the beauty about the U.S. data is we can track everything weekly in real time. If you look at the last 8 weeks, it's the largest draws in U.S. oil stocks in history. Diesel stocks in the U.S. are at the lowest level since 2003. I think U.S. refiners have helped to fill in the shortfall of refined products in the East and in Europe. And as long as trade is free, the tightness will be felt very much in the U.S. too.
How much do you see actually getting through the Strait of Hormuz right now? We've had reporting that ADNOC is getting product out. The Japanese prime minister had a call yesterday with the Iranians. Yeah. They got 15 ships out. Are you seeing more get through because individual nations are striking their own deals with the regime?
So we think that about 10 to 15% of normal oil volumes are coming through, 2 to 3 million barrels per day. But it's a challenging data problem as ships turn their satellites data off. So we are also tracking arrivals of oil. We're tracking inventories data, 10 to 15% of normal. But it's a challenging data measurement issue.
If the Strait of Hormuz were to open today, how much would oil prices go down because of the demand destruction that we already see in certain places?
I think the risk premium at this point has come off quite a bit, along with positioning. I would expect that if the Strait reopens fully and on a sustained basis, that the risk premium comes down somewhat further. But I think oil prices will stay high. We have Brent at 90 in the fourth quarter just because inventory levels are very, very low. Most of the risk premium at this point has come off.
So wouldn't you say that the upside risk is substantially greater than any kind of downside risk going forward, and that ultimately people are still on the low end of the pricing curve, both now as well as in December?
Yeah, we see the risk as two-sided, but skewed to the upside on net. If the demand weakness we're seeing in gasoline markets in China and Western Europe were sustained, we would predict Brent at 80 by year-end. But in practice, I expect that that demand weakness should unwind once conditions normalize. On net, still upside from a more persistent Hormuz supply shock.
Our experience with this story of the last 3 months, terrific engagement in the first month. The second month, things started to fade. And the third month, no one even wants to talk about it. Can you describe the arc of your conversations with clients? How engaged are they still with what is taking place in the Middle East?
Clients are tired. It's a challenging trading environment with headlines moving prices up and down. I think positioning in oil markets is significantly more limited than at the start of the conflict.
Have they stopped engaging in the market because of that? Have you seen certain pockets of this market in commodities where liquidity started to dry up because people aren't engaging in the way they were before?
Traders are telling me that liquidity, especially in the refined product markets, is pretty poor at the moment. And I think many corporate clients, investor clients, have already set up the hedges they wanted to implement. And many of them are in a wait-and-see game.
So when you see liquidity dry up, how much signal can I take from the paper market, from futures, right now?
Yeah, somewhat less than in normal times where liquidity is higher, for sure. So that's why you need to complement the price information with looking at stocks, imports, exports, anecdotes from clients on the ground. All of these are necessary to get a sense of what's going on.
Dan, appreciate it. Thank you, sir. Thank you. I think everyone's exhausted by this story, including Dan himself, I'm sure. Dan Struyven there of Goldman Sachs.
Yeah, but the point that you were making at the end was fascinating to me because ultimately it indicates you can't really get comfort from the long end of the oil curve right now if it has less information than it normally does. And Mike Wirth of Chevron saying
doesn't even look at it.
Probably he doesn't look at it.
It's his best case for the consumer.
Right, and his range talks about that as being the best case and the potential bad cases being to the moon. Where is the downside surprise and how great could that be? Potential to the upside that seems not unlimited, but problematic.
Skewed asymmetrically to the upside.
Thank you. Yeah, that's the way it
I think that's where you would go in. I'm reading your mind, Bramo. All right, break crude right now.
I appreciate it.
94. Let's get you an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. SpaceX will reserve up to 5% of shares in its upcoming IPO for certain employees, along with friends and family of executives. The company has already disclosed that participants on its so-called friends and family list will not be subject to a lockup restriction. NBA star Stephen Curry signing a 10-year endorsement deal with Chinese apparel brand Li Ning. The agreement includes basketball products, lifestyle wear, and a full golf line. The four-time champion ended his longtime partnership with Under Armour back in November. And a 24-hour strike by some London Underground drivers started today, causing major disruptions around the city. Talks between the union walked out over a dispute over plans to introduce a voluntary 4-day working week. A second strike is planned for Thursday. That's your Bloomberg brief, John.
Yahara, thank you. Thank you for the update. More from Yahara in about 30 minutes' time. Up next on the program, higher for longer.
This economy really is on fire. If there is a rate hike cycle beginning because of these factors that we both have a low unemployment rate and at the same time we also have upward pressure on inflation, then all those things would certainly argue for the risk to the upside.
Neil Dutta, Ran Mac joins us next, live from New York. You're watching Bloomberg TV. Things are pretty quiet at the index level this morning. We're down by 0.2% on the S&P 500, down by not even 0.1 on the Nasdaq. Things are very noisy at the single name level. Check out Alphabet, down by 2%, not a big move, but they're making major moves. An $80 billion equity capital raise to build out the big AI push over at that company. And other companies are absolutely raking it in. HPE in the pre-market, the stock is absolutely flying. It's up by 26%. Revenue will increase 31% in the fiscal year ending in October, according to them. Analysts were looking for growth expectations of something closer to 20%. So analysts were bullish. They were nowhere near bullish enough.
Yeah, because demand just keeps outstripping supply. The book report came out from Peter Bukvar, and I thought that this headline of the email gives you a sense of where people's minds are at for the economic ramifications. This is going to cost you. Talking about how the data center is keeping the build-out is keeping the U.S. economy afloat. And guess what? It's really expensive, and you are seeing that in the earnings. You're seeing that in the capital raise, and you're seeing that in just how big the beats are for the people who are in the choke points of some of this build-out.
So what does it mean for the bond market? Might sound like an odd question, but I think it's a question we need to explore a little bit. So yields are close to 4% on twos, 10s around 4.43. Two dimensions to the fixed income story off the back of this conversation in tech. One is inflation, and the second is crowding out. There's a lot of debt coming to the market to fund this big push. And to your point, there's a lot of price pressure building in that sector as well.
At a certain point, right now, AI is inflationary. How long is it going to be until it's disinflationary, number one? And number two, how much do you have to have a much faster growing economy to support some of this build out without seeing potentially constraints coming into play? And this is the reason why Jim Caron over at Morgan Stanley put out a note yesterday where he was saying that people need to get used to a world with higher inflation, higher benchmark rates, and higher growth. And right now, people are trying to get their heads around that after decades of exactly the opposite.
Where does it leave this Federal Reserve? Under surveillance this morning, higher for longer.
This economy really is on fire in the sense that we both have strong growth and we also have upward pressures on inflation. If there is a rate hike cycle beginning because of these factors that we both have a low unemployment rate and at the same time we also have upward pressure on inflation, then all those things would certainly argue for the risk to the upside, namely that rates are going to stay higher for longer.
So here's the latest this morning. Investors are waiting a slew of jobs data this week, likely to confirm expectations that the Fed will drop its easing bias. Neil Dutta of Runmac warning the Fed is focusing on the wrong side of its dual mandate, writing the more relevant issue right now is how weak income growth is. Neil joins us now for more. Neil, welcome to the programme. I'm guessing you're pushing back against the idea this economy is on fire.
Well, I think certainly to your point earlier, I mean, parts of the economy are on fire. We've seen rapid growth in information processing equipment and software. But I think, there's a disconnect in terms of strong nominal GDP growth on the one hand and very weak wage and salary growth on the other. We'll see how that reconciles. But generally speaking, I think, incomes, labor markets are the more stable measure of activity. And so I tend to put more weight on that.
So, Neil, why do you think the Fed, at least for now, seems to be more preoccupied with the other side of the mandate?
Oh, sure. Inflation owns the Fed's reaction function right now. There's very little doubt at this point that they're going to drop their additional adjustments language. But I think the reason why inflation's been the focus is because we've been running above target for a while. And when you look at things like non-housing services, they appear to be, flattening out, or the progress has stalled over the last, 6 months or so. So, there's only so many times you can say, well, this is a function of this idiosyncratic factor. This upward pressure is a function of tariffs, and that'll go away. If everything is idiosyncratic, then nothing is. And so I think that's the reason primarily why inflation kind of owns the Fed's reaction function at the moment. And of course, while income growth is slowing, the unemployment rate isn't rising. So you need to see more of a cathartic crack in the labor markets to kind of get the Fed's attention.
What does a cathartic crack look like, Neil?
Yeah, if the unemployment rate starts going up a couple tenths every month for several months in a row, that'll be something that'll get their attention.
At this point, if you don't see that, and if you see incomes continuing to be subdued, do you think that the next move is going to be a hike or a cut? I mean, do you think that the Fed can feasibly cut rates to help people who are more rate sensitive at a time when you're seeing valuations run away and it doesn't seem to be that financial markets see any kind of tightness in any way?
Yeah, well, I don't know that the Fed can do anything about what's happening. I mean, financial market conditions can shift abruptly for reasons totally unrelated to the economic fundamentals, as we know. I think what it basically does is lock the Fed into place. Even when you talk to the people that are calling for hikes on the street, right? What are they saying? It's sort of like stages of grief. Like it's almost like a momentum trader with the sell side, right? It's like, oh, they're going to drop their easing bias, then they're going to, talk about balance of risks, then they're going to hike. And how many times do you think they'll hike? Oh, maybe once or twice. Well, look, I have news. I don't think the Fed will only go once if they go, okay? The Fed will probably go 75 to 100 basis points. They'll take away all the insurance cuts that they put in last year. So going out there and saying they might hike once at some point in the second quarter of next year, that'll be wrong. Okay, so that's sort of what I would say. So to me, it's about distribution of sort of, this is a probabilities business, right? Either they're going 75 basis points with respect to hikes, or, oil prices settle down. We kind of go back to where we were at the end of February. and then the markets start pricing in cuts again. Maybe that's early next year, or they do nothing at all. You basically have an extended hold. I think those are the distribution of outcomes. And if I have to pick, I would say the path of least resistance is probably that they do nothing. So I would sort of lean against the idea that they're going to hike.
Neil,
that's
don't
kind
they
of
just
where I'm
need to
at right
say this, though, in a sense, to make sure they keep inflation expectations under control?
Well, they're doing that, right? I mean, they're basically dropping their balance of risks or sort of their additional adjustments language. They're telling you that they're prepared to move in either direction should the economic conditions justify it. But I really have a tough time seeing them hiking if there's not much meaningful inflation pressure coming out of the labor market.
If for them to hike, what would you need to see in terms of, you mentioned
I just
oil
told
prices?
you, the labor markets would need to reaccelerate, meaning wage growth would need to perk up.
Neil, very simple. We appreciate it, sir. Neil Dutta gets fired up about the Federal Reserve, doesn't he?
He gets very fired up. And about Knicks. I mean, if you look at these Knick tickets and the cost of them, you would think the Fed needs to hike. Ask him. Nick, are you... Neil, are you going to the Knicks game?
Well, in classic K-shaped economy fashion, I will be. I'm not going to. I'm not going to MSG, unfortunately.
Okay.
But I will be going.
Cut rates. Neil Dutta of RenMac. Neil, thank you. Neil wants cheaper tickets. I don't think you get them by cutting interest rates.
No, but it seems like he's going to go anyway, at least maybe not in Madison Square Garden. I mean, what is it, $75,000 people could resell their tickets for?
Ridiculous, Bramo.
No, there's some that are $250,000.
But then there's the debate, do you sell or do you not sell? If you're a diehard fan and you've got
if you're a diehard fan,
tickets.
I guess you go.
I've spoken to diehard fans about this.
They're holding on to the tickets?
A lot of them are holding on to the tickets. It's been decades of just brutal torture, so.
It's someone else's money, so I don't want to tell people what to do with their money. We'll say this, though. I do appreciate when the stadium is full of actual fans and not people who just paid up ridiculous amounts of money for the whatever the spectacle of the moment is, and in this case, it's the Knicks at MSG.
I feel like this is a perfect parallel for some of the chip supply shortages.
Please, make this work for us, Bramo.
Because it's sort of like demand is insatiable and supplies are limited.
Yeah.
And so do you hold on to your supplies that could potentially be productive, or do you sell potentially for a big profit in the moment? But that money, what is it worth versus the experience?
OK, I think that kind of worked.
Thanks.
Appreciate it, Bramo. Thank you. Up next, we'll get back on track. Monica Dicenso of JPMorgan, Colin Sebastian of Baird, Reid of RBC, Ohsung Kwon of Wells Fargo. The third hour of Bloomberg Surveillance just around the corner.
Nothing matters except AI, 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 and a little more AI.
It's a very narrow market. The earnings are being driven very, very small slice.
We're in a high-risk bull market.
It does feel a bit like a meltdown.
Our personal view is to hedge.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Record highs through Monday. Coming into Tuesday, equity futures down by just 0.2% on the S&P following an 8-day winning run. Quiet at the index level, lots to talk about at the individual single name stock level. Let's start with Alphabet. $80 billion. Equity capital raise, and the stock is down by just 3% this morning.
After a nearly 120% rally over the past 12 months, this is a $40 billion so-called at-the-market program to sell shares from time to time. This is $30 billion of underwritten offerings of shares of mandatory convertible preferred stock, as well as, and this is the interesting part, $10 billion coming from Berkshire Hathaway. Greg Abel is putting their cash pile to work. Is this giving people a sense that this actually has legs, given the fact that Berkshire Hathaway in the past hasn't been that hot on tech? Or is this just a sense there isn't anything else to invest in? Right now, if you're going to invest in anything, you better get a hold of some of this AI stuff.
So Berkshire's sitting on what, $400 billion cash pile?
Crazy.
Let's round it up. Does it make a difference to you that it's Greg and not Warren? And if it was Warren, would you take a different signal from this morning?
Absolutely. I think Warren Buffett was pretty vocal. He did take a stake in Apple. It wasn't necessarily as profitable as some of his other stakes. People talked about how he didn't get his head around some of the technology trade that other people did. He didn't have the same level of success. Greg Abel clearly is taking a different tact At the same time, it clearly is Berkshire Hathaway and comes in tandem with other types of investments, the housing one in particular, that are more traditional in line with the Berkshire Hathaway types of investments.
And when it comes to Alphabet, when you have this company, it is almost an infrastructure play as well, not just what is going on in models like Google Gemini. I go back to what Mandeep said. They are in both places right now. They are competitors with Anthropic and OpenAI, but absolute, they are competing with NVIDIA because they have the chips as well.
They're just exploiting pockets of liquidity up and down the capital structure. They've been so busy all year. $60 billion 4-month debt bench. I know I've repeated that number a few times, but that's massive. That is bigger than they borrowed in the debt market in the whole history of the company up until the last 6 months or so.
I'm losing sense of scope when we start talking about numbers like this. You were joking before about $1 billion here and $1 billion there.
It's
and
difficult to internalize
here.
These numbers.
I'm struggling to put that in perspective with the grocery prices or my day-to-day life. And I know that might not necessarily be relevant. Groceries versus an AI company are completely separate. But do these valuations make sense in the price environment that we have currently, or does there have to be a rejiggering of our sense of the world? And I don't mean to be too philosophical, but this is ultimately where it comes to the underlying economy and it comes to the question of the bond market. At what point are we either underpricing growth and inflation, or are we overpricing the hopes and dreams of AI?
Well, let's start with capital constraints and a signal you get from price. Not seeing pushback in the debt market to Alphabet. They raised a lot of money. There was a lot of demand. They had to go into different currencies to do it. They were smart about it, but didn't see much pushback. And you have to say, and we mentioned this a few times already this morning, pull up Alphabet again, look at the stock price. Not seeing much pushback at the single name level either. Alphabet is down by 2.8%.
The signal here is go for it. If you want an IPO or you want to raise money in the equity market, now is your time, which is why you have a race right now between OpenAI and Anthropic. The Dario Amodei versus Sam Altman create that video I'm willing to watch. This sort of rivalry coming to the fore of who's going to get there first.
Well, I do like the timing because, as I've said, Alphabet got there first.
Like,
They saw what was on the horizon and they said, no, thank you, we're public already, we'll have some of that.
Yeah, hold our beer.
Thank you very much.
And guess what? We did it really well.
Bigger than the SpaceX IPO, this capital raise. Coming up, we'll catch up with Monica Dicenso of JPMorgan as capital demands ramp up. Colin Sebastian of Baird as Alphabet looks to raise $80 billion. And Ohsung Kwon of Wells Fargo on how the mega IPOs could be a headwind for the stock market. We begin this out with stocks holding on to record highs as Alphabet is planning to raise $80 billion in equity capital. Monica Dicenso of JPMorgan Private Bank saying the following: stay invested in the AI supercycle, but be selective. Monica joins us now for more. Monica, good morning. Good to see you.
Morning. Thank you.
I'm just thinking about the clients that you speak to, investors, individuals, families, family offices. How much exposure do they have to these names already through private markets?
It's funny. Talk about private markets with everything that's happening, these headlines overnight. I think so many people assumed that's where you had to be to get the value today, to play AI, and then you see this news overnight and you realize maybe there are more opportunities in public markets. Now you look at a name like Alphabet, which has run over 100% in the last year, and to see it holding in this well this morning is pretty interesting. And so I think the bottom line is there are absolutely opportunities in private markets, but there's still a lot to do in the public side as companies make investments. And you look at these companies like Alphabet with a significant free cash flow generation, it still feels like there's value on both sides.
Where do you think the value is then in the equity market? Let's explore that a little bit more on the public side. Where do you see it at the moment?
You know, at the beginning of the year, we were a little worried, right? Because you looked at valuations over 20 times, you know, earnings growth, high single digits, and you said, okay, maybe that's about where it should be, maybe a little stretched. And then you had all the geopolitical fears, and you said, okay, can we actually hold on to 20 plus times? And now here we are, and what's happened, obviously, earnings have significantly outpaced what we thought. But it's not just earnings growth, it's revenues are accelerating, margins are expanding, and again, it's not just tech, you're actually seeing breadth. Because a year ago, the big concern was, it's just the Mag 7, it's just tech. We're seeing that margin expansion in most sectors, actually. And so that's what's really interesting, that you're finally seeing some of this follow through in the market. To me, that tells me fundamentals actually might be better than people thought, and maybe 20 times isn't outlandish for equity markets.
What's driving the broadening out? It's certainly not coming from cheaper commodity prices. It's not coming from disinflation. So where is it coming from?
You know, it's funny because a year ago, year plus ago, everyone would push back and say, how can margins expand? And that's where you get to this AI story. And you haven't seen it, I think, as significant as it will be. But I do wonder, are you starting to see some benefit from these investments? again, it's really hard to put numbers around it. And I think that's where the market struggles, that's where investors struggle. Because if I can't put an estimate on it, how can I look at a valuation and say this stock is worth, X in 2 years? But it seems like it has to be there. And then you wonder, okay, if companies raise prices, never actually took them back down. If there's been some moderation in the rate of inflation, then that obviously helps on the margin side as well.
There's always some unknown when you're investing in a technological cycle. But if I think about, say, the Industrial Revolution with the train, you're investing a train to get from here to there. With this, it's different. People don't totally understand exactly what iteration is going to be one at the end of whatever this is. How difficult is it to remain nimble and to remain lithe at a time of such incredible uncertainty around the thesis that's raising trillions of dollars?
I think it's really difficult. It's why you've seen this concentration, I think, in these tech names, right? Those are the deep pockets, clear beneficiaries at the beginning. When we talk about being nimble, being selective, now most of my clients are saying, where else can I invest? Where are the sectors that haven't worked? Who could be a beneficiary of AI? And I look at something like financials. Sector that's been down while the S&P is up over the last few months, and yet probably stands to benefit from rates hanging in here. And certainly if you're a financial institution, you will benefit from AI. It makes it easier to underwrite credit. If you get a little smarter, a little more nimble in some of your businesses, and suddenly you can make an argument for another sector to benefit. And so I think that's where we're trying to look, is who hasn't participated in this rally. Another sector that I love looking at, healthcare. If you believe in AI, how can there not be significantly more innovation on the biotech side, globally? And you have seen a dislocation between healthcare and tech over the last couple of years.
Is it on the margins is why you say the upside is underappreciated when it comes to AI? Is it on the margins of these other sectors that could benefit?
I think it's just, I used to be a sell-side analyst. We'd estimate numbers going out 1 or 2 quarters. That's kind of what you did. How do you predict 3-4 years out and actually do a DCF and figure out what these stocks are worth when you have really no idea how to put pen to paper on this? And I think that's what the market struggles with. It's what investors struggle with. And so when you have these game-shifting things, it happened in the dot-com bubble as well, people struggle because it's really hard to see 5 years out. And so that makes equity investing a bit challenging. And I think, again, it's why people go to the obvious places. But now we're starting to see money want to shift to other areas, and this is going to be the challenge over the next year. Who are the next 2 to 3 sectors that will benefit from this trend?
The critical question for every client is your portfolio built for a world of higher and more volatile inflation. Are your clients right now more concerned about AI and the future and how to predict this 4 or 5 years, or actually the conflict in the Middle East, or people have just completely moved on?
It's so funny. The questions around the conflict in the Middle East, at the beginning of the year, it was all about AI and is it a bubble? That has dissipated. I think because this earnings story has started to calm those fears. Then it's about the Middle East. Yet, to your point, I don't see portfolios that reflect this fear about higher rates, higher inflation. And so and that's normal. People tend to kind of lag a little bit with these shifts. But after this equity rally, I think you have to look even at some of these tech names and say, okay, should I take a little bit off the table and think about rebalancing? Do I have enough in the sectors that will benefit if inflation remains sticky/higher? So I think, again, core real estate, infrastructure, things like that. We look at large family offices we work with, still significantly underallocated to where they say they want to be. And I think no one wants to chase, but it does feel like you probably need to have a little more balance there. These things didn't matter in your portfolio 5 or 10 years ago when rates were lower. Now they're going to be much more important, I think.
Monica, this was smart. It's always good to catch up with you. Thank you. Thanks. We appreciate it. Thank you. Monica Dicenso there of JPMorgan Private Bank on the opportunities in public markets still with this big push from some major companies.
Now it's who's the next one. We heard that yesterday. Who is going to be the next Anthropic or OpenAI in this time where everyone can be a billion-dollar company? Why not you? Start it in your college dorm room. I mean, that's essentially the hope and dream.
You've got plans, Bramo?
I mean, I don't plan to go back to college, but I do think that this is the discussion among a number of college kids
at home. Is this Casa Bramo again? Is this dinner time?
Actually, there was a really good op-ed by a Stanford senior who was talking about how everybody felt like, well, have you created a billion-dollar company yet in your dorm room? Because I'm working on one.
Oh my goodness! And if you haven't, you're behind.
And if you,
yes, I couldn't handle that.
I mean, Torsten Slot just put out a note about how this is accelerating job creation and company creation because everyone wants to have a small business. I can have it at my kitchen.
I was reading the Bernie Sanders op-ed. And I was just looking at things in a different way. I'll be sitting this out, and then we'll just tax everyone 50%, right?
Mm-hmm. Is that where you're going?
That's what Bernie's going to do.
Yeah, that's the legislation.
That's what Bernie would like to do.
That's the legislation.
Senator Sanders, I should say.
Yes, that's the legislation he's going to be introducing. He wants Americans to have direct ownership in these AI companies because he says they are using our culture, our history, everything Americans have put out there to compute all of this and create all of this.
So look, whenever these conversations start, they're always anchored to the crazy, to the extreme. So yes, you can say some of that is extreme and it won't happen, but that's the start of the conversation that's going to build up into the midterms, then build up a little bit more into 28. And what do you think the Democratic primary is going to sound like on this issue in the next few years? What do you think it's going to sound like? What kind of policy proposals do you think are going to come out of that?
It's not just Democrats. It's also Republicans. We're seeing this pretty broad-based. I asked a banker, does this present a problem for some of the tech companies that are going to be issuing debt, considering the potential regulatory overhang and the potential pushback? He said it actually accelerated valuations because there is a race to build out data centers as quickly as you can now before they get better regulated. And then it will improve the valuations of those data centers. So, either way.
Two things. Even the Trump administration is telling Meta, Microsoft, you need to subsidize Americans' electricity bills when it comes to data centers. Second, Steve Bannon says that Bernie Sanders doesn't go far enough. Steve Bannon was a key architect to Donald Trump's rise. So it's not just going to be the Democratic primary. It's also going to be the Republican primary.
It's just the start of the conversation. NASDAQ futures this morning down by just 0.1%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Alphabet is raising $80 billion through a package of equity offerings, including an investment deal with Berkshire Hathaway. The move underscores just how expensive the AI race has become, with the company planning to use the money to build out AI infrastructure and meet growing demand for its chips. Meanwhile, Apple is planning a new iPhone feature that will let users split bills for group dinners or other events. The feature, tied to Apple Cash, will allow users to take a picture of a receipt, assign items to different people, and generate payment requests. And in sports, Serena Williams is returning to tennis. The 23-time Grand Slam singles champ will play doubles with a yet-to-be-revealed partner at next week's Queen's Club tournament in London. 44-year-old Williams is making her return nearly 4 years after stepping away from the sport. That's your Bloomberg brief. John.
Yahara, thank you. Thank you for the update. Up next on the programme, the morning calls, plus Colin, Sebastian of Baird on Alphabet's historic spending surge. That conversation up next, live from New York City this morning. Good morning.
Still early innings. I do think the questions will start to be asked in terms of when is the payback on this capex, because these numbers are staggering. Where I start to worry in the market is if the rally becomes broader. I could see a world where there's so much frenzy around AI that anything that even touches the supply chain gets seen as an AI beneficiary.
That was Momei Qu of PSP Growth, just fantastic a little bit earlier on this morning. If you're just joining us this morning, good morning to you all. Equity futures pulling back just a little bit. We're down 0.2 on the S&P. On the NASDAQ, we're down by 0.1. That's the price action this morning. Let's get you some morning calls. First up, Goldman downgrading Intuit to sell, saying estimates are too high as it faces heightened competition. Your second call from JPMorgan, nearly doubling its price target on CrowdStrike to 800, saying it's one of the best positioned names to benefit from securing AI. Just can't keep up. And finally, Bank of America raising its price target on HPE to a street high $80, citing strong demand and further wins in networking. That stock this morning up by 28%. Let's talk about tech and the AI race continuing to heat up. Anthropic confidentially filing for what's expected to be a massive IPO ahead of its longtime rival, OpenAI. Bloomberg's Ed Ludlow tracking the story for us. Ed, good morning. Talk about that race, SpaceX, Anthropic, OpenAI. We have to start with Alphabet because Alphabet got there first. What is the window that Alphabet was looking at?
Yeah, I mean, $80 billion, it's hard to kind of say, well, is that a lot of money? It's more than SpaceX plans to go to market for in an IPO. The structure of it's very interesting. You know, Berkshire Hathaway quietly at the end of last year started building a position. It adds $10 billion to that. And then the ATM mechanism for 40 is kind of like helping the market ease into it. But I think the main point being that, you know, Google or Alphabet has warned pretty clearly that capital expenditures beyond this current year will be higher, right? $190 billion this year. I think the team at Bloomberg Intelligence think $300 billion, a $300 billion capex year is possible. The money has to come from somewhere, even if your cash generation is really strong. So it was not a shocker, but it was a big piece of news after market last night that puts this, if you want to go to the IPOs, it's a race for capital. right, rather than the race to list in Alphabet's case.
So, Ed, how did you think about the last 24 hours, just to put a button on it? Did you see it more as not about how much they'll be spending, but how they'll be financing it? Was that what the last 24 hours was really about?
Yeah, I hammered the phones. I think I've said this on the show in the last 10 days. There is not infinite liquidity or infinite capital out there. And so in a year where SpaceX tries to raise $75 billion at that valuation, Anthropic and OpenAI may go in the fall, and there is commonality in the existing cap table and then those cornerstone or crossover investors that come in, people have to make decisions. And you see that reflected in the most recent private round activity. People that backed Anthropic at $965 billion valuation were already on the cap table at OpenAI and are making decisions. But that's certainly the feedback I've been getting in people I've been speaking to, that Anthropic filing confidentially is first mover advantage, but it's not just a race to go public. If you fold Alphabet and what happened in last night, it is a race to secure capital, where capital is not infinite.
Ed, great framing, buddy. Looking forward to the programme. Bloomberg Technology in a few hours' time. Ed Ludlow alongside Caroline Hyde. The race for capital in both the debt market and now the equity market as well. Colin Sebastian of Baird writing the following. We view these new offerings as yet another indication of the scale and urgency of the AI infrastructure build-out, along with the scale of demand. Colin joins us now for more. Colin, good morning. Good to see you.
Good morning. Thank you for having me.
Let's just talk about the scale of supply and how much demand there is there to meet it. There's going to be a lot of supply in the next 12 months.
There will be a lot of supply, and even then, it's capacity constrained. And I think what we're seeing is this AI race is now quickly becoming a capital markets race. And I think, to put it in perspective, we've already seen over $600 billion raised in the past 2 years through a combination of debt and equity to fund the build out. So we're still in the midstream of this massive build out.
Where is the money coming from?
It's coming from a combination of the private markets, the public markets, equity and debt, and really, I think, a lot of constituents that have a stake in AI. Obviously, a lot of funding of companies from the hyperscalers themselves.
What I'm getting at is how much is coming from investments in tech, in other instruments? How much is coming from, say, bonds? How much is coming from just the money market funds that people talk about going to $8 trillion? How much will these pools of capital be drawn away from other assets that could potentially see a detriment as a result?
Well, I think we're in that point in time when AI perhaps is the best use of cash for a lot of these companies. And so, yes, it might draw capital from other pools. At the same time, a lot of the companies we're talking about now are some of the biggest producers of cash, for example, Alphabet. So for them, in terms of capital allocation, it makes the most sense for them to invest in this area right now, which protects search, which protects cloud, instead of perhaps other investments.
How do you wrap your head around valuations that are so significant? How do you wrap your head around trying to game out revenues over the next 5 years, given how quickly they've been expanding over the past 2?
Well, look, it's a great question. ROI is the big question here. And, we have a survey which we'll announce this week that 100% of enterprises surveyed are now deploying, not experimenting, but deploying AI. It's a big change from just the last 12 months. So I think the indications are there that we're on the cusp of a hockey stick in revenues. And that justifies, I think, in the minds of a lot of these companies, the amount of infrastructure that's being built.
Was $80 billion enough?
Well, it's a stepping stone, right? $600 billion in the last 2 years, $80 billion is actually not a significant part of that amount. I guess it's meaningful, but it's not the end of the road.
So they can keep doing this?
They can keep doing this. Look, we project $1 trillion of CapEx next year from the hyperscalers for the AI build-out. 80 billion on $1 trillion is still not likely enough. But remember, Alphabet is probably the best producer of cash in the world, and they have a massive business which is already benefiting from AI.
To your point, they're already a cash machine. They've just borrowed a lot of money in the debt market. They're borrowing 80 billion. If you need to borrow numbers like that to be a player, how high are the barriers to entry to this business already?
Well, these are large moats that are being created, and it's a great point because it's not really who has the best model anymore. It's who has the ability to fund this build out through the capital markets. That is the new moat. At least that's the moat this year. And so thus we're seeing other companies go public, reach out to the capital markets. A lot of the constituents here are trying to participate.
Who are they locking out? Right? We keep talking about the winners and how much they're gaining and how their revenues are expanding. Who are seeing their revenues shrink or collapse?
I don't know that we're seeing anyone else's revenues collapse. It's really part of this transformation towards AI. And I think the way we look at it is the infrastructure part, which is obviously a lot of the investment. We know who the winners are here already, but it's a lot of the same companies that we saw in the cloud transition, Google, Amazon, Microsoft, for example. And then in the models, we know who the winners are there. It's really the application side. This is where software and SaaS is getting, certainly has been hit quite hard. That's where the uncertainty is, and that's where we might see some of the revenue dislocation.
Is that because increasingly people think that will just be commoditized?
Yes, the commoditization of applications, AI native applications emerging, which threaten the existing SaaS group, and a lot of uncertainty around the future of how people will use AI. That's very different than the infrastructure side, which is, of course, the physical side of AI, which we can see already, I think, happening.
We're struggling to figure this out in real time. Colin, it's good to see you.
Thank
you,
you.
sir. Putting
Thanks
the piece of the puzzle together. Colin, Sebastian of Baird. We've got no idea what the picture looks like in a few years' time.
Yeah, I keep going back to Jim Caron. So he is over at Morgan Stanley, and he said this: the key investment question for 2026 isn't whether growth collapses. It's whether investors can adapt to a world where nominal growth, inflation, and interest rates all settle structurally higher than the last decade. If everyone's making money and everyone's expanding and everyone's investing trillions of dollars, well, that's going to have to come with both faster growth but also faster inflation. And wrapping your head around that after 3 decades of financial repression is very difficult for a lot of people.
That is not the original argument the incoming Fed chair was making, about interest rates at least. So it's going to be interesting to see how he thinks about these issues in a few weeks' time at the news conference.
Especially because there's a huge question mark around it. I mean, we can't say any of this definitively. Even people who are in it can't game out exactly what this is going to look like at the end. But based on these numbers, it certainly is presenting a picture that you at least have to consider.
We'll talk about policy in just a moment. Up next, we'll catch up with Michael Reid of RBC on why the Fed will be shifting its focus for Friday's payrolls print. Plus, Danny has got your morning movers. Another check-in on HPE. Check out the name. Crushing estimates. To see the name up like that, up 27% in the pre-market. That story just around the corner. The opening bell about 60 minutes away. Equity futures pulling back by 0.1%. We're down by 0.15 on the S&P, pulling back from all-time highs on the Nasdaq, pretty much unchanged. Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Alphabet out with an $80 billion equity raise. It is huge figures for them and decisively changes the AI capital expenditure stories from one that was about balance sheet and debt to one that is a capital markets event. Remember, this is the same pool of capital that's also going to be competing for money with all these mega IPOs coming to market. At the end of the day, it is a dilutive event. Shares down 2.8% for Alphabet. Elsewhere to the upside this morning, HPE out with blockbuster earnings. They beat expectations. They also raised their guidance. They give an early forecast for next year, which is rare. They make networking equipment for data centers, so they are a popular business right now. Shares up 27.33%. Finally, in earnings, we also heard from Victoria's Secret. A huge beat. Their profit was more than double what was expected. They also upgrade their expectations. It also probably helps them this morning that there was a large short position out against Victoria's Secret. So they're up 38%. Citrini making the point that really dictating spending and style is women who are 18 and in their 20s, and portfolio managers are decidedly not women 18 to and in their 20s, so maybe a big value gap presents itself for a company like Victoria's Secret. John.
Danny, thank you. That's a point well made. Appreciate it. Danny Berger with the latest. There's a couple of names this morning that make a lot of sense from a fundamental perspective. I know the move in HPE is large, but the beat was large as well. So directionally, you sort of understand that move. Then you look at something like Marvell, right? You've got the NVIDIA boss invested in the name, coming out and saying this might be the next $1 trillion name, and you get a moonshot at a single name level. They're the kind of moves where you sort of go, that's maybe a little bit too much.
Yeah, although I wouldn't be necessarily following the crowd, then the crowd will turn around and say, haha, we won. So essentially that tends to be the play that has worked, and how many people jump on a train with Jensen Huang and buy some leather jackets, and they end up in a good spot.
Just to differentiate between the moves. Anyway.
100%. Absolutely.
You know.
One is vibes and one is reality.
Well framed. Futures this morning down about 0.2%. Lots of data for the week ahead. We've got a full slate for you leading up to Friday's payrolls report. ISM data more recently showing US manufacturing expanding by the most in 4 years. We're now looking ahead to JOLTS at 10 a.m. Eastern time before we get ADP claims and then payrolls on Friday. Bloomberg's Enda Curran joins us now from Washington for more. Enda, welcome back to the program. Let's get the update. So ISM manufacturing headline level really quite strong, I think 54. What did you read in the details beneath the surface?
Manufacturing was strong across the board, John. Almost all the sectors except the wood sector actually saw growth. And that's really interesting given we all know the backstory about how manufacturing has been struggling. People are saying it's not just linked to the inventory story on the back of the Iran war with companies rushing to stock up inventories ahead of any price shock there. It's also reflecting pent-up demand. So it's a strong, good news story on the manufacturing side. And by the way, the manufacturing sector is expected to feed into the strong jobs report due at the end of the week as well. So we're off to a strong start. The job openings data coming later today as well also expected to show an uptick in the labour market. So certainly it seems to be shaping up to be a firm week for the economic data.
So, Enda, we've all seen these massive numbers, $80 billion capital raise over at Alphabet. We know a lot of companies are coming public to fund a lot of infrastructure investment, data centres, chips and the like. And how much of these data points that we're seeing, these big moves, this nice momentum we're starting to build in things like ISM manufacturing are just that, one particular part, one specific part of the US economy driven by tech?
Well, I mean, that has to be a big part of it, John. We know that the AI boom, the data centre build out, the equipment that's needed for that, the import boom that's associated with that is driving demand for labour. And in particular, we're starting to hear now in the construction sector complaints of labour shortages. Now, that obviously reflects the immigration story as well, but it is also reflecting the AI boom story. So there's no doubt AI is front and centre to what's going on. However, equally, there is a bit of a sting in the tail there because if you listen to the Fed policymakers in recent weeks and indeed other economists are saying the inflation story is no longer just about tariffs. It's no longer just about the Iran war. It's also now reflecting what's going on with this AI boom, given the demand for the inputs and the components that are imported, the equipment and the machinery, and now, of course, the workers. All of that is, too, adding to upward pressure on inflation. So AI boom driving activity and capex, but also having some impact on the inflationary side.
Enda, good to see you, buddy, down in Washington. We'll catch up later this week. More data still to come. Enda Curran there. Speaking of the Fed, Beth Hammock of the Cleveland Fed saying this might soon be appropriate to act if the inflation trend persists, setting up for a more hawkish, relative to the last meeting coming up later this month.
These comments are coming in prepared remarks that are coming out. She's in Cleveland at an event. She has been more hawkish, which is notable. At the same time, this is a new layer, that it's not just a theoretical hiking bias, but it's actually the potential for the Federal Reserve to consider an action. Right now, most people in markets think the Fed will jawbone the market with some sort of equal or neutral positioning. Whether there actually is willingness to hike rates, though, a lot more skepticism.
A bit of a communication exercise taking place over on the FOMC, perhaps. Michael Reid of RBC calling for 99K in payrolls on Friday. He writes, the interpretation of payroll gains is changing. We expect the Fed will rely more on the unemployment rate than the payroll report to gauge labour market health. Michael joins us now for more. Michael, good morning.
Good morning.
So unemployment 4.3. You expected it to stay at 4.3?
Well, we think the odds of the unemployment rate ticking down are greater than the odds of it ticking up in this case. So you have the break-even pace of employment, which we estimate is quite low, maybe around 20,000 per month right now. So if you get 3 consecutive months of gains over 100,000, that points to a potential downward surprise.
When do they start to worry about wage inflation off the back of a move like that? At what point, what number do they start to get nervous at the Federal Reserve?
Yeah, I think right now we're not seeing any signs of wage pressure. I mean, it has cooled off quite a bit, especially in some of the sectors that were overhiring during COVID. So, you know, for something that we see around the end of the year, you know, January, February, when you start to get those cost of living adjustments, that's when we would be more concerned. I think right now you're just looking at the mix of different jobs, and right now the jobs that are being added to payrolls aren't necessarily adding to a wage level that is consistent with demand, you know, outstripping some of the supply issues that we're seeing right now.
I'm experiencing cognitive dissonance right now. I'm having a lot of trouble because we're having all these discussions about the trillions of dollars being raised for tech companies, about insatiable demand to buy supplies, about all the capex being built out at all these different companies, a variety of different industries. And then we're talking about anemic wage growth and an economy that's cooling down in certain sectors. Can you square those two stories for me?
Yeah, I mean, there's a lot going on here. So if you take manufacturing as a good example, and we were just talking about ISM manufacturing, look at the new orders index. That's been up quite notably this year. At the same time, their employment index is still in contraction territory. So this is more a story of productivity, capacity utilization ticking up. So that's one story there. At the same time, when you think about wage growth, the way I interpret it in terms of the payroll report is you look at the sectors that are hiring. We know healthcare is going to hire. That's going to be our stalwart. But when you have sectors like retail trade and wholesale trade, which tend to pay below average wages, adding disproportionate share of jobs, that's going to make that kind of headline number look a little bit weaker. So that's what we do see is you still have sectors, retail trade, throw in leisure and hospitality, other services, which tend to pay those below average wages.
So then is the wage growth figure accurate to really reflect the heat in the labor market? Because ultimately, if the composition of jobs is changing, it doesn't mean that someone is going from a high-paid job to a lower-paid job. It means that people are getting jobs, and they might be lower-wage jobs than some of the others. That doesn't necessarily speak to weakness. It just speaks to a job composition story. So we could still see a labor market broadening out and strengthening and reacceleration, even with some of this wage data, no?
Yeah, we can, and you can absolutely see that, you know, as a counter to some of those sectors that are hiring. We do see some weakness in your traditional white-collar jobs, finance, insurance, professional services. And that's where some of the pain is being felt. And in particular, in one of our reports, we highlighted that recent grad cohort. So when you think about the alignment of folks who are coming out with a bachelor's degree and have all that college debt, and they're not able to get a job that maybe they were expecting and have to settle for something that pays a little bit lower, that's not going to feel good. And I think that's what we're seeing reflected in some of the consumer sentiment data in the Conference Board. But at the same time, they do have a job.
Michael Reid, I've got some deflation. Do you want me to break some news? This from Sri and the team here at Bloomberg. The first signs of deflation associated with tech. Thank you, Elon. Elon Musk and SpaceX negotiating razor-thin fees to Wall Street firms who are working on its IPO. If you want the number, the fee structure thereafter, they're negotiating to pay less than 0.75 for the $75 billion they're looking to raise. Sri and the team here at Bloomberg just breaking that news moments ago. If you're interested in what the fees typically look like for a very small IPO, nothing like this, let's say you were raising $1 billion, you'd be looking at something around 4 to 7%. As you get larger, something closer to 1% maybe, but certainly these bankers, I'm sure, were looking for something north of 1%. The fee pool, though, still likely to be around $500 million based on what they're about to raise. So there's plenty of money to go around. Lots of people are going to make lots of money, and clearly Elon Musk is well aware of that and is pushing for lower fees.
Weren't there reports that David Solomon personally contacted Elon Musk on X to try to get some sort of slid into his DMs to try to get this this underwriting assignment? The race to underwrite is clearly quite significant, and Elon Musk is not one to miss a beat in terms of leverage use.
That's the only deflation I can find. Everywhere else is inflationary, based on this tech story, and Lisa's been talking about this a lot over the last few hours. Are you focused on the same thing? What we hear and what we see, companies raising a lot of money in the debt market, a lot of money in the equity market, pushing it into a supply-constrained economy, particularly in the tech sector, an economy that's faced a series of negative supply shocks. Is the end outcome, the end result, just higher inflation?
That's what we expect. I mean, you look at PPI, and that's where a lot of the early signs are showing up with these inflationary pressures that you point to. And when you think about also some of the worries around demand destruction, we're kind of dismissing those, at least for now, again, because PPI is just showing strong margin growth, especially in that wholesale retail space. When you look outside of that, it's really hard to point to an area within PPI that would show prices coming down. And then, of course, when you think about what passes through the consumer, again, you have a big part of the story being housing, which we think that the deflation has ended for much of this year. And then the healthcare story is one of demographics. So you have continued demand there. Those are two of the biggest buckets of the consumer bucket. So it just doesn't paint a picture of inflation slowing or coming down anytime soon.
Michael, it's good to see you. Thank you, sir. Michael Reid there of RBC. This is the dimension of the news conference of the Federal Reserve in 2 weeks' time that I'm more interested in. And it's also intriguing to me, increasingly so, that when we talk about inflation, we're hardly talking about the shock in the Middle East. It's almost like the shock in the Middle East just amplified and put a spotlight on the inflationary backdrop for the economy more broadly, particularly with regards to the tech story. And when you talk to investors, at least through this morning, about what would happen to this conversation if the Strait reopened and that story went away, they think this would still be a problem. And this would be a Federal Reserve that would still have to consider exactly what it's going to consider in just 2 weeks on Wednesday.
Yeah, ultimately, even if the conflict does resolve in the Middle East, people are saying, A, oil prices aren't going to go down that much, and B, that's not going to change anything from the inflation with respect to AI demand. Beth Hammack, we were just speaking about the Cleveland Fed president. She said, based on the data, I'm more concerned about the growing risks of a persistently elevated inflation than the risks to full employment, and also that monetary policy may not be sufficiently restrictive to bring inflation down to 2%. She talked about the two-sided risk, the risk of not doing enough up front, allowing inflation to become unchecked, and then having to do so much that ultimately torpedoes the economy.
Futures this morning negative by close to 0.2%. Let's get you an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Oh, how the tables have turned. Anthropic moving ahead in the AI race, filing an IPO ahead of its rival OpenAI. The company saying in a blog post that the number of shares to be offered and the price have not yet been set. And as you were discussing, SpaceX is pushing for record low fees for Wall Street firms handling its IPO. Still, sources telling us here at Bloomberg that banks are still poised to collect roughly $500 million from what could be one of the biggest market debuts ever. The lead banks, Goldman Sachs and Morgan Stanley, are positioned to take in a larger share of the pool than others involved. And in sports, Game 1 of the NBA Finals tips off in San Antonio tomorrow night with the Spurs taking on the New York Knicks. Game 3 will be played at Madison Square Garden on Monday. Single tickets and prime spots are listed for more than $100,000 on resale sites, and nosebleed seats are going for thousands of dollars. That's your Bloomberg brief, John.
Oh, the K-shaped economy. It's just crazy.
No, this isn't K. This is I-shaped. This isn't even I-shaped. This isn't even a letter. This is just ridiculous.
It's just ridiculous, truly. New York sports was crazy anyway. I would complain about the US Open every single year around September time about how expensive the tennis tickets were over at Arthur Ashe. This is just another level. This is bonkers.
Down payments on housing.
There's a price for everything.
Lifetime savings for a lot of people.
Crazy.
So is that enough, though, for a night to experience your dreams come true?
I love sport. Not that much. Not that much.
Yeah, the price for everything.
Up next on the programme, we'll set you up for the day ahead, plus Ohsung Kwon of Wells Fargo on how historic IPOs could be a headwind for tech from New York City. You're watching Bloomberg TV.
This is not even close to the 2000 cycle. The only comparison is animal spirits. This is a major infrastructure rollout, nothing that we've seen in my lifetime. What's fueling this market is the cloud titans, and it's going to go for a while. You just put gas on a fire.
Fantastic conversation earlier this morning with Ted Mortonson of Baird on how Alphabet just extended the runway for CapEx investment with an $80 billion equity capital raise. If you're wondering what happens in commercial breaks, I often share some of that with you. All these conversations about AI, CapEx intensity, tech revolutions, Alphabet, etc., etc. Bramo has not talked about anything but barnacles on vessels in the Strait of Hormuz for the last 3 hours.
Okay. I have talked about other things, but that's been the bulk of it. I've been really interested in some of the tangible ramifications of ships hanging out in the Strait of Hormuz,
so what's
waiting.
The problem? Where are we at?
That barnacle growth is a real problem in the Strait of Hormuz, in that region, as well as algae and other things, and jellyfish. And it's clogging up the propellers. It's clogging up all sorts of the functioning of these ships. So they've got to clear out all the barnacles and algae and jellyfish in order to even get moving again.
According to the Financial Times, it's a huge issue in terms of degrading their speed and fuel efficiency.
Thank you.
So, okay, this will become a problem, maybe. But the biggest issue is right now they are trapped. 2,000 ships are trapped. The Strait of Hormuz is not open. And the Chevron CEO, Mike Wirth, said there's going to be a line. We don't even know who can get out first, let alone who's going to be the first one to go underneath the ship and clean up the barnacles.
Grandma, if you go out for drinks tonight, you'll lose people at the Strait of Hormuz. You won't make it to the barnacles on the vessels, right? That's where we're at in conversations right now.
Yeah, which is why I'm not going to be going out to drinks tonight.
Equity futures on the S&P. Neither will I.
Yeah, I was about to say, what are you talking about?
I'm the least social person around the table. On the Nasdaq right now, just about unchanged. That's the price action. This is the week ahead. Some data a little bit later. 10 a.m. we'll get jolts, so look out for that. 1 p.m. we get a White House press briefing. On to tomorrow, results from Broadcom, CrowdStrike, plus ADP, durable goods, and ISM services. Claims are on Thursday. Payrolls are on Friday. In focus for this market right now, though, is the AI arms race, heating up with record spending plans and blockbuster IPOs on deck. Ohsung Kwon of Wells Fargo writing, we continue to expect the speed of the rally to slow. We remain bullish on AI, but we believe the mega IPOs will be a headwind. Ohsung joins us now for more. Ohsung, good morning.
Good morning.
This is a change. We've gone from shrinkage to a lot of supply on the horizon. How is that going to change your approach to this stock market?
Yeah, there's more supply, and it is a headwind. I don't think it's going to be a big headwind right away because the issuance size is relatively small compared to the overall market cap of the S&P. But as more lockups expire starting in August and on, I think in the second half of the year, I think the setup is more cautious. We essentially went from being very bullish in April to sort of starting to moderate the tone a little bit. We're still more bullish than bearish, but as we look into the second half of the year, I think the market's going to become more volatile.
Where are you looking to lighten up in anticipation of that?
I think you still have to own AI, right? I think you have to own the underlying AI stocks. Our call is to sell cover calls against it because call premium is very, very rich. It was basically everyone's consensus that this is $19.99. That's reflected in the options market. If you look at call premium, it's insane. So we like taking advantage of that high premium in call options against the underlying assets.
What's the hangover from the sugar high look like? I mean, are we talking about actual declines, some sort of correction, or are we just talking about a cooling out and a flattening out for a number of months?
Yeah, so the reason why we like selling calls over buying puts is because we don't see that much downside risk either, at least right now. Because until growth actually starts to slow down, which hasn't happened yet, or we see more risk around the AI CapEx cycle or monetization, which we are not seeing yet, I think it's too early to be more bearish. So we like the idea of, the rally is likely to slow down. I think the sugar high rally that we were calling for is toward the later innings of the rally. So if that's the case, I think you can make extra income by selling some calls.
How much are you seeing certain companies that are not necessarily directly related to the AI trade try to refashion themselves as AI companies? I'm not just talking about Allbirds. I'm talking more broadly about companies that can say that they too can hinge off some of the economic expansion tied to this technology.
Yeah, I think some of that is true. That if you look at Q1 GDP growth, 1.6% GDP growth, 50% of that was driven by semis and hardware. And if you include intellectual property, so things like software, it was 95% of GDP growth that was driven by basically tech and AI. So AI is really the economy overall. And I think that's the rising concern to us, that AI is getting maybe too big, that unless other parts of the economy starts to grow, there's probably a ceiling on how much AI can grow. So semis and hardware right now is about 2.5% of overall US GDP. And based on hyperscalers' consensus estimates, that number is going to go up to 3%. It's above the internet peak level, 2.9%, and in line with the railroad investment cycle back in the 1850s. So this actually might be as big as it gets unless other parts of the economy starts to grow more.
You think when it comes to the Fed that stocks are skewed to the upside when it comes to Warsh's first meeting, even though everyone knows that they're going to remove the easing bias. So what's he going to say that you think stocks are going to take off?
Yeah, no, I think it's going to be tough for them to out-hawk the market. So already one hike is priced in by January. So for them to out-hawk the market, I think it's going to be difficult.
Ohsung, always good to catch up with you, buddy.
Thank you.
Thank you. Ohsung Kwon there of Wells Fargo on the issuance, the supply we'll see later this year and the volatility he's expecting.
Yeah, just the idea, his last point there was really interesting, that the economy has to grow into this AI cycle or else you're going to see some sort of capping out and just what kind of sugar high there is. You have to see participation. You have to see return on investment. You have to see people keep up with the numbers that are getting more and more incomprehensible.
They're building out capacity aggressively. And then you ask them to describe the future. They're not really sure what it looks like. They're not really sure what it looks like. But they have this conviction that the biggest risk right now is underinvesting. Now, when you have some of the biggest companies on the planet with access to capital markets that they have, both debt and equity, Alphabet, telling you something like that, you pay attention, you take note. And the moment that Alphabet told us that a few summers ago, that was a major headline for me. That was a major statement. Here's a company telling you exactly what they think about the risks on the horizon and how they're going to invest accordingly in the coming years. And look at the numbers now.
Yeah, they're bearing fruit in a massive way. You just think about what Peter Scheer was talking about. When you talk about the buggy whip and how they went out of business when an automobile came and put the horse and buggy out of business, are cars what they were to humans, or are cars what they are to horses? In other words, are we the horse or are we the human? Because ultimately you knew that a railroad was going to move things from one place to another. A car was going to move things from one place to another. Is AI going to help us do our jobs, or will it do the job for us? And these are the questions that people are asking.
It depends who you ask, but that is why you see policymakers like what Jonathan was talking about, Bernie Sanders, an opinion piece saying Americans and everyday individuals actually need to be the ones that reap the benefits of this, because it is just too explosive.
Enhance or replace. Pick your poison right now. There's a message that's more palatable to Washington and I think for a lot of the country, and maybe Mr. Altman's got the message.
AI can't remove barnacles. That's the reason why I find it fascinating.
The important stuff.
Thank you.
We know how you'll be spending the rest of today.
100%.
Okay.
Seriously.
Coming up tomorrow, stacked lineup for you. Cameron Dawson, New Edge Wealth, Michelle Weaver, Morgan Stanley, Libby Cantrell of PIMCO, Alicia Levine of BNY. From New York City this morning, good morning. This was Bloomberg Surveillance.